The FX market, 119.41, positive about 0.1%. That right there, Lisa, just a little bit of a stronger euro in the mix this morning.
Yeah, which is interesting because we saw the dollar strengthen. That was the knee-jerk reaction after the fiscal support bill seemed to gain steam and gain support on both sides yesterday. It's been reversed, which I find quite interesting. Meanwhile, what will shake bonds out of their stupor? Will it be the inflation data that's coming out in about 2.5 hours? We're going to be getting personal income, personal spending, and the key metric here, core PCE. This is the PCE deflator. This is the metric that Federal Reserve officials look at most closely. They have a target of 2%. It is expected to come in at or around 3.5% year over year. Transitory. Expect them all to say this, and there is plenty of Fed speak. We are going to get to this. Watch the income actually come down, decline as a result of less fiscal support. But on the flip side, watch spending, because you're going to see services spending overtake spending on goods. A lot of people are looking for that shift. Consumer sentiment coming out from the University of Michigan at 10 a.m. I'm personally very interested to see what the expectation is for longer-term inflation by consumers. This can be predictive. This can also be somewhat self-fulfilling. If people expect inflation to go up, they will respond accordingly, and it will be more likely to go up. So that will be interesting to watch. And the roster of Fed speakers continues. Drum roll. Neil Kashkari, Loretta Mestre, Eric Rosengren, John Williams. None of it matters. That, according to at least former Fed official Bill Dudley yesterday. Not necessarily. I'm absolutely butchering his words. But he was saying the key people to pay attention to, John Williams, as well as the Feds, of course, Jay Powell and Rich Clarida.
So you saying don't listen to Kashkari, Mestre, and Rosengren today?
I will say listen to them. It could be really interesting fodder for discussions. But as far as the balance of power on the Federal Reserve and what the Federal Reserve will do, I'm just going to take it from Bill Dudley.
That is so diplomatic.
I'm trying.
We've turned you back from a columnist and back into a journalist, haven't we?
Yeah, don't pay attention to them. Pay attention to John Williams. Pay attention to
That's the columnist in Lisa that we know.
Come on. This is we all know that that's the case, and yet the noise that does seem to be picking up has given a little bit more volatility to bond markets. However, it's been transient.
Thank you, Lisa.
Anytime. I try.
Let's turn to the banks board and get you a flavor of what's happening with the banks in the pre-market right now. We're shaping up as follows for the banks in America. In the pre-market, inching higher on JP Morgan by a little more than 1%, on Bank of America by the same amount, Citi up by 0.8%. Taylor, I imagine this was a big theme for you in the close as we got those stress test results, a green light to pay out a whole lot more.
Yeah, finally some good news. But this, John, was actually something that most analysts were expecting. Not a big surprise. Of course, we'll get the exact numbers maybe as soon as Monday after the bell. So, John, that's really going to be the key focus. Remember, a big run-up year to date despite some of the underperformance in June. Well, how much of that was expected given the big outperformance? Finally, at least catching a little bit of a break.
Looking at some of the estimates, Lisa, 6 of the biggest U.S. banks could return $140 billion to shareholders off the back of all this.
Yeah, and yet you're not necessarily seeing this huge boost in share prices. This, to me, is kind of shocking. Is this built in? By the way, the interview of the day yesterday, Savita Subramanian, yesterday on your show, talking about don't be a chicken, lean heavily into these. And I am wondering whether that seems to be what people are doing.
I thought Jonathan Golub took that pretty well, I've got to say.
I
thought it was pretty fascinating because they basically agreed on everything.
I know.
And if you didn't know, it sounded like they disagreed on everything.
That was how you summed it up, and I thought you were right on. I was trying to figure out what the difference was in their opinions, and they both were saying lean into cyclicals, but they were really hashing it out in the process.
You can catch the clash of Bank of America and Credit Suisse on Bloomberg.com and on the Bloomberg terminal. Let's get to Don Rismiller, shall we? Strategas Research Chief Economist. Don, let's just start right here. We went straight to the bond market off the back of this deal down in D.C. Snooze. What do you think the bond market is smelling?
So we've been watching this pretty closely, and I think the market just isn't convinced that we've made enough progress yet, since this bipartisan bill is supposed to move in tandem with a reconciliation bill. The other issue is when we look at infrastructure spending generally, there are good reasons it should be done. It's a long-term investment into the economy, but is it really near-term stimulus? Infrastructure spending can be notoriously slow. It can take many years to get into the economy. And when we think about an economy that already has job openings surging, where will we find the workers to complete this infrastructure bill? So we want to think of it more as a long-term investment into the economy rather than short-run stimulus.
Well, Don, you say, where will we find the workers? And yet in a series of charts that you put out, which I thought were fabulous, you point to the fact that the U.S. labor force participation rate has declined quite substantially. So where have all the workers gone?
So some of this is industry-based. If we look at a sector like leisure and hospitality, you can find a big decrease, and that's because this cycle, rather than being driven by goods and by a financial crisis, was driven by services and by a health crisis. So again, when we think about infrastructure hitting the economy, say a year out, we have to think about the unemployment rate by that point being lower and the labor force participation rate by that point being higher. The Federal Reserve has said they expect a pretty robust labor market, and I would agree with that. That's coming quite soon. When we think about the infrastructure piece, that's going to be on top of that, perhaps 12 months plus down the road.
All right, so let's talk about jobs. We got those jobless figures yesterday. They came in a disappointing manner, higher than expected for the initial jobless claims. We've seen mixed data coming out of the labor market with signs of ongoing friction. Do you see signs of that easing in some of the high-frequency data that you track?
I think that's fair. I mean, the jobless claims number week to week is always volatile, and you typically want to look at a 4-week average. Even that number over the past several weeks has been a bit disappointing, as you mentioned, and that's true, and that's worth acknowledging. But just think where we were 3 months ago, 6 months ago, or 12 months ago, if we really want to draw a comparison. So we've seen some improvement. There are still some bottlenecks. There are still health concerns. There are still concerns in the education sector. The pieces of the economy have not fit together as well as they did, with schools still partially closed. And there could be some issues with the expanded benefits that are still being provided in some states. Most of that should start to resolve itself as we get through the summer. So I think that's the base case for why you'd expect a continued improvement.
Where are we then in the delicate balancing act that is fiscal stimulus bearing the brunt of the recovery versus monetary stimulus? Does this allow the monetary stimulus to take a step back?
So not quite yet, or not in any significant fashion. So the issue that we're looking at first is going to be when to taper asset purchases. So we have to take a step back in the sense of ease less before we can think about tightening. And in the meantime, we have to think about the fiscal drag that will come about as we lap the big fiscal stimulus. So just not doing the same thing we did over the course of the past year in the next year is going to create some fiscal drag. And then we'll see where we wind up on the tax code and other things like that as we get into 2022. But the starting point is that we still have some uncertainty on the health front. We still have some uncertainty on the fiscal drag front. So for now, monetary policy, I think, wants to get those variables into their models first and then see where we wind up as we go into 2022. But the first step would be a pretty mild step in terms of a taper. And then you want to talk about tightening down the road.
Hey, Don, it's good to catch up, as always, especially this morning. Don Rissmiller there, Strategas Research, Chief Economist. Your equity market, all-time highs, 4260 on S&P 500 futures this morning. We add a little bit of weight to it, up 4, advancing about 0.1%. Lisa, tapering is not tightening.
No.
We're going to do that all over again on repeat through the next several months.
The idea here is if they're going to reinvest the proceeds of what they earn from the bonds, they're going to keep their balance sheet at a very high level. And this doesn't mean they're going to be tightening monetary policy. Just to give you some perspective, yesterday, 4:30 p.m., you know what I do on Thursdays?
I know exactly what you do.
I check out the Fed's balance sheet, and it was $8.1 trillion, a new high. Just to give you a sense, Bloomberg Economics thinks it's going up to more than $9 trillion, which will be 35% of the U.S. GDP.
Well, to your point, Lisa, and I think it's a really good one, even when the tapering begins, even when the QE stops, in inverted commas, you're going to get that reinvestment. That stock effect is going to be massive for a long time.
Yeah, and basically Bloomberg Economics thinks it'll take more than a decade for the balance sheet to fall below 20% of the U.S. GDP. I mean, how does that affect the rest of the market? Does it really have that big of an effect?
Yep, we'll see. Lisa Brambidge, Taylor Riggs. Great to have Taylor with us through the next several hours, waking up early to replace Tom Keane, who I'm told is having a nice, lovely, long weekend.
No resentment.
We sure hope so.
Lobster rolls or something like that. I think that's the text I got yesterday.
Yep.
Something about a car that talks. More on that a little bit later.
He's talking back.
Yes, 4260 on the S&P. Your bond market, a snooze, 148.67 from New York this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Vice President Kamala Harris heads to the U.S.-Mexico border today. She'll tour a Customs and Border Protection facility in Texas and meet with immigrant rights advocates. Her visit comes after months of criticism from many Republicans, as well as frustration from some Democrats for not having gone to the border after President Biden picked her to address the root causes of migration from Central America to the U.S. Officials in India rejoiced earlier this week when the nation hit a single-day record by administering more than 8 million COVID-19 vaccinations. But that pace may still not be fast enough for India to head off a third deadly wave of the virus. Officials are also questioning whether the faster rate of vaccinations can...
Okay, day traders, time to place an order to sell short Japanese yen. I'm looking to sell short at 110.745. So I'm placing an order right now, and I'm going to wait until this order will fill. So I'm placing an order. If you want to copy this trade, if you want to follow this trade, stay with me, place an order with your own broker, and wait. Oops, that's great. Right now, position opened on Japanese yen at 110.745. It's a short position. Okay, guys, all of you guys who managed to place an order and fill it, stay with me, and I will guide you through. We'll close this trade in profit. Stay safe, and I'll speak to you later, guys.
particularly, sort of the technology landscape gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We didn't get everything we wanted, but we came up with a good compromise that's going to help the American people. This is about infrastructure.
We've got an infrastructure package that really meets the needs of this country for the 21st century.
It sends an important message to the world as well, that America can function, can get things done. Today, we are delivering.
We've got a lot to talk about. That was Senators Rob Portman of Ohio, Joe Manchin of West Virginia, and Susan Collins of Maine. From New York City this morning, good morning. TK out of the building alongside me, Lisa Abramowitz, Taylor Riggs dropping by. I'm Jonathan Ferro. Your market all-time highs, 260. 42.60 on the S&P, just short of that right now. Up another 1% for equity futures. In the FX market, euro stronger, euro dollar 119.40, up 1%. Your bond market, not much to talk about, 149.35. Yields this morning, basically unchanged. So here's the quote. It comes from the White House, Lisa. The president came into office promising to find common ground to get things done, and he's delivering on that promise. I guess. There will be this bill they agree on, and then there's said to be this other bill that they really do not agree on.
Right, and he's going to try to jam them together and get them all through at the same time. And the question is, can he? Or is he going to have to forego either the bipartisan support or, frankly, support from his own party? The idea that Democrats kind of getting off board when he tries to push through this bipartisan, much smaller bill.
We need some help down in D.C. Let's bring in Bloomberg government reporter Emily Wilkins. Emily, let's start there. Make sense of this for me. Can you achieve this bill? Can you pass this bill if the Democrats are going to force through another one, which everybody disagrees on?
Potentially. We have heard some Republicans come out and say, look, why would we go ahead and support a bipartisan bill if we know that Democrats are just going to go ahead and pass a trillion-something bill with what they want in it? However, Republicans do have an incentive to say that, look, we got something done. We got something done with roads and infrastructure. I mean, if Democrats are going to go ahead and do this anyway, Republicans want a piece of that pie. They want to go home to their constituents and say, hey, this new road, this new bridge, this new broadband that we brought you, I helped do that. I supported that bill. So there is some incentive here for Republicans to go along with a bipartisan infrastructure bill, even if Democrats are then going to move their own package of priorities.
I actually get it from the Republican standpoint much more, because it seems like they got more of what they wanted. It's a smaller headline number. Infrastructure is defined much more narrowly. How much resentment is building in the more progressive wing of the Democratic Party? In other words, how much do they need this reconciliation bill? Do they need the add-on in order to get anywhere near passing the $579 billion agreement?
You know, from the progressives who I've talked to in the last couple of weeks, one thing always comes up, that they will not support a bipartisan infrastructure bill unless it moves alongside a larger reconciliation package. And they declared victory yesterday because you saw House Speaker Nancy Pelosi come out and say that that was the way they were going to move forward. You heard President Joe Biden say that he wasn't going to sign an infrastructure bill until he had that reconciliation bill on his desk. So progressives are pretty motivated by that. They think that that's a good thing. At the same point, that also isn't being taken well by some moderate Democrats who say, you know what, we have this bill right now, we have this bipartisan infrastructure bill, we need to move on that and pass that and not necessarily wait around to get all the Democrats together on another package, because that doesn't just happen immediately. There is a wide range of opinions within the Democratic Party, and it is going to take time to get your Joe Manchins and your Bernie Sanders and your AOCs and your Blue Dogs all on the same page.
Yeah, I was going to say, sort of the key question is, what will Joe Manchin do? What does the reconciliation bill look like? How much wiggle room is there in terms of getting it to a size where the Joe Manchins of Congress can sign off?
So that's a great question. At this point, Senator Bernie Sanders is putting together what he said is a $6 trillion package. That's going to include things like child care and expansion of health care, but we haven't seen the details on it yet. And so when talking to lawmakers on Capitol Hill, it's hard to get a real sense of exactly whether or not they support it. Progressives are happy with that $6 trillion number. They'd like it to be a little bit higher. Moderate Democrats are a little wary of it. I talked yesterday to one moderate, Josh Gottenheimer from New Jersey, who called that number aggressive. But at the same point, there is an underlying sense among Democrats that they do need to pass something, that the worst thing they can do going into the 2022 midterm elections is go back to voters empty-handed. And so there is that momentum that they all have to come to some sort of compromise on this.
Emily, the markets yesterday, I guess, relatively pleased that there weren't tax increases included in the $579 billion. How and when are we going to discuss how to pay for this?
So we have a couple ideas how to pay for this. This includes the idea that bolstering the IRS will help more tax money come into the U.S. Republicans and Democrats have also talked about paying for this plan via public-private partnerships. But look, Taylor, the market shouldn't be too excited right now because we do have this $6 trillion plan coming, and that could potentially include some of these tax proposals that President Biden has put out there. I mean, yes, part of the reason he put these proposals out there was because he wanted to pay for a larger package. But the other thing is that Democrats really believe that some of these incentives are quite popular, that the American people feel that our current tax structure is favoring the rich and corporations, and they want to see more balance there.
Emily, just thinking ahead, what comes next? When do we get maybe more clarity on if this goes through enough or not? Is it weeks or months?
I think at this point, it's going to have to be weeks because from the timeline that House Speaker Nancy Pelosi and Chuck Schumer have set up, we're going to need to start moving quickly. I mean, we're talking about this budget reconciliation. But for that to go through, we first need to pass a budget resolution. And that's going to be its own battle. I mean, I've seen reporting this morning with 2 Democrats already saying that they don't think they're going to support a budget resolution for a large reconciliation package. All the votes that Pelosi can lose in the House is 4. If we've got 4 Democrats saying no on anything, it's not getting through the House. And if you've got 1 senator saying no, it's not getting through the Senate. So that's a big debate that's coming up before we even touch that reconciliation bill on the floor. And so, yeah, there's a lot to get done. I think the timeline really puts this, depending on whether or not they stick around for August, because they're supposed to be gone the entire month, we could easily see this go into the fall.
Hey, Emily, good to catch up. Good to see you. Emily Wilkins down in D.C. of Bloomberg Government. Lisa, there's a big difference between saying we have a deal, we have a bill that can pass. Those two things are very different.
Yeah, if we have a bill, and how about we have another one, too, that needs to pass alongside it.
And it's really big.
And it's really big. It's $6 trillion, and that's not necessarily big enough to please a lot of the people who feel a little bit shafted from the $579 billion bill. I mean, look, there are a lot of asterisks, and I wonder how much that goes to your point of why we're not seeing any reaction in the bond market.
Well, let's go there right now. 10-year Treasuries, 149, south of 150. 30-year yields at the moment, close to 2.1%. No big moves off the back of this. The front end has been elevated over the last week. We stay there at about 27 basis points. Is it the size of the bill that's driven the disappointment or the prospect that none of this passes?
Or the prospect that when it does pass, it'll be carried out over such a long time in tandem with tax hikes that it won't lead to longer-term inflation. And that's what you're seeing with the flattening yield curve, perhaps. Maybe all of the above, John?
This, Taylor, is going to be the debate, I think, over the next several weeks as we continue to hash this out.
It's the debate as you hit record highs on the equity markets yesterday on the S&P, NASDAQ 100, John. It is the defensiveness tone of that market without records from the Dow and the transports that caught our attention.
All-time highs coming into the weekend, 42.60 right now on S&P 500 futures, just short of that, up about 3 points on a day. From New York City this morning, good morning. Alongside Lisa Bravitz, Taylor Riggs, I'm Jonathan Ferro. This is Bloomberg. Good morning from New York City. All-time highs on the S&P 500 at the close on Thursday. Right now, we add to it a little bit. 42.59 on the S&P, advancing about 3 or 4 points, up about 0.1%. My good friend Matt Miller earlier this morning, about an hour ago, talking about the average, the median estimate for year-end, 4,300, just short of that on the S&P. The band, though, outside of that, pretty wide. You've got Bank of America at the low end at 3,800, Credit Suisse at the top end at 46. Just something to think about, to pore over as we go into the open in a couple of hours' time. Switch up the board and get to the banks. This is a big story. A green light, as expected, for the bank stress test. We're about to find out how much they'll pay out. The estimates for the top 6 stateside is $140 billion worth of payouts. As Taylor pointed out earlier this morning, you're going to start to get a hint of that after the close, Monday, June 28th. The banks this morning, JP Morgan up by a little more than 1%, B of A a similar amount, Citigroup up by about 0.8%. But this is the debate, the conversation that Lisa and I are having this morning. Switch up the board and get to the bond market. 2s, 10s, 30s, treasuries. We've got a deal. Okay, yields 149.35 on a 10-year, on a 30-year lease, so just short of 2.1%. That's tumbleweed, just rolling through the bond market. As they tell us down in D.C., we've got a deal.
You would think that if they start to talk about $6 trillion in spending alongside a $579 billion infrastructure bill, somebody in the bond market would care. They don't. That's
what does that tell you? What does that tell you?
Either tells me that it's priced in, that people don't believe it can get through, or that people do not believe that, as written, it will be inflationary in any meaningful long-term way.
I think most people would agree. 149.18, Lisa, on a US 10-year this morning.
All right. Well, we're going to dig into this a little bit more deeply, as well as ahead of the PCE core PCE data that we're going to be getting in about 2 hours' time. Jeff Mortimer, BNY Mellon Wealth Management Director of Investment Strategy, joining us now. Jeff, there is a key question about this transitory issue. Is there anything that we could see on the fiscal front that could change people's view about the transitory nature of inflation? What's your interpretation, exactly as John was laying out, of the lack of bond market reaction to the infrastructure plan in Washington?
I think you two are hitting the nail on the head. Bond markets have been fairly tepid for the last couple of months, really signaling, perhaps even in front of equities, that they really didn't see any longer-term inflation. And I think this proposed infrastructure bill is I think small enough, or puts payment far enough out into the future, and also I think mitigate a little bit on the tax hike side. I think it just sort of markets are taking that in stride. And as you've said, I don't know if they are discounting, what the probability that this passes as written is, but I think they like the idea that two sides in Washington are at least working together and have come to a modest modest conclusion.
Jeff, I got to say, in your decades of experience managing money, overseeing markets, have you ever seen a time where markets are less fazed by every bit of new information? Inflation print comes in higher than expected. Meh. Infrastructure plan gets passed. Meh. I mean, literally nothing can shake the market consensus, which is everything will just keep chugging along. What's the analogous time frame?
I've studied markets going back to the 1960s, almost day by day. And I will tell you, as I look at today's market and map it historically, bull market cycles come in 3 phases, and we are in the middle phase of this one. Innings 3 through 7, if you want to do a baseball analogy. Historically, mid-cycle bull markets that we're in today, an adjective used to describe them is resiliency. Mid-cycle bull markets have an ability to digest a lot of news and treat it as a glass half full, with a glass half full analysis. They have an amazing ability to accept bad news and to sort of shrug it off. And yet if you give them good news, they can rise substantially. So you're sort of in this positive bias market. Other time frames where you've been in mid-cycle bull markets are the mid-aughts, 2004 through 2006, the mid-90s, and even 2013 through 2015. We're back in that sort of phase where markets sort of take a lot of news in stride. It's puzzling if you don't sort of understand where you are. As you get into a late cycle bull market, that is where you run into trouble, where sometimes good news is not absorbed well in markets because valuations are too high, markets are too narrow. We're just not in that situation today.
Jeff, we've got to talk about this more because what you're discussing is so important. I get the luxury every morning of just asking questions. You've got to take positions. Feels like to me that this cycle has been really, really condensed, really, really reduced just in terms of the time frame. And I think the question we've got to start asking, I look at a 10-year that topped out in late March at 177 intraday, whether we're starting to see a mid to late cycle dynamic take over this bond market already. Any sign of that for you, Jeff?
That's possible. Late cycle bond markets, right? The recipe for ending a bull market in equities is higher inflation and then a Federal Reserve which has to raise interest rates in order to combat rising inflation, right? That's the textbook answer. Bull markets can end from shock, overvaluation, right? Some other ways at the end, but a textbook is through Federal Reserve taking the punch bowl away, the proverbial punch bowl away. So I think if inflation remains contained, if we get through this reopening, right, demand has reopened a lot quicker and more easily than supply has. So I think we've got to get through another couple, perhaps high inflationary prints. But as you look at the forward curves, like you're even looking at the 30-year and the 10-year, the bond market isn't really saying that inflation is anything except temporary. And I think if that continues, that gives more weight to the mid-cycle argument, I believe. As we move to a late cycle, that's where you may get higher inflation, higher rates, right, as you sort of move down the path. But that could be years from now, a couple of years from now even. Bull markets tend to give 50% of their return in their first year of life. The first year of this bull market's life was 75% return. If we were to get that over the next few years, another 75% or so return in markets, again, we'll see how that goes, but that's where my time frame is. That could change at any moment if inflation or rates or some issue sort of pops in. But I think that's the path of least resistance here, especially if Washington sort of behaves and gets on with its business without raising taxes significantly, or sort of comes to the middle more than they have in the past.
Yeah, Lisa, the reason I bring this up is because we're already seeing credit spreads the tightest since 2007. Lisa, we've got equities at all-time highs. And when you start to get that bull steepener come back through, you do start to think about where we are at the moment.
Well, and this is
bull
actually...
flattener, rather, forgive me.
Well, but that's what I was thinking about as you were talking. I mean, where are we in this credit cycle, given the fact that, as you said, it's been condensed and these companies have a lot of leverage? Jeff, does that concern you, the whole zombification of the corporate credit market, of all of corporate America, given how much borrowing they have done? And yes, they've reduced leverage a bit over the past few months, but overall, pre versus post-pandemic, these are deeply indebted companies that have to grow quite a bit to grow into their capital structures.
Agreed. We need to have a stronger economy, as was mentioned, for a lot of these companies and our government to continue to service debt. The ability to service debt at these rates is quite easy, right? But if rates were to rise, it might put some pressure on capital structures of companies. We have an overweight in high yield within our allocation for our clients. We continue to debate that at the committee level because we're cautious now to really debate whether or not you're getting paid for the risk that you're taking in the high yield market because the spreads are, as you mentioned, so tight. So we continue to have that debate. We've made no changes to our allocation as of yet, but it's something, just as you're discussing now, something very much on our minds.
Jeff, on that note, do you position for further dollar weakness given the debt deficits and monetary policy that for now isn't going anywhere?
We were dollar neutral going into the year to maybe dollar bearish. So we have a slight overweight to emerging markets within our equity allocation for our clients. We're underweight international developed and continue to be underweight for a number of years, have been underweight for a number of years. Some of that, of course, is currency related. So I think the dollar probably stays around these levels to slight sort of downward tick, which may help clients who have some money positioned outside of the country. That's how sort of I look at that. And I think also if the dollar remains up at these levels or can hold near these levels, it's very good for the inflation backdrop, right? A weakening dollar can be inflationary. So I think if the dollar is to remain up here, which again, we think it's sticky with a slight downside bias. So it's not influencing a lot of our decision making at this juncture.
Euro dollar right now, 119.40, slightly weaker dollar through much of G10. Hey, Jeff, it's great to catch up, as always. Jeff Mortimer, BNY Mellon, Wealth Management, Director of Investment Strategy. Lisa, as Jeff was talking there, That question, am I being compensated for the risk I'm assuming? With the exception of maybe a small window at some point last year, when you think about the last 10 years, ask yourself that question. When was the answer yes?
Well, that's the thing. It's like if you're not getting any yield in the full faith and credit market, as Tom would say, yeah, you're getting 2.78 percentage points over benchmark rates to own risky corporate credit. And yet, where else are you going to get that? And I think that's what people are saying. No, I'm not getting compensated. But you know what? I don't have the luxury of going out and looking at a 5% coupon right now.
High yield needs a rebrand. How many times have we been told that, Lisa?
Literally
that high
a decade.
Yield needs a rebrand. Taylor, high yield needs a rebrand because high yield is no longer high yield.
It is just junk, John. One of the key statements I heard yesterday was don't take on high yield risk if it's acting like an equity in the portfolio. Just buy an equity. And so you're sort of getting that extension of credit risk. How is that behaving in your portfolio? If high yield's behaving like an equity, buy an equity.
I got to say, Jeff Mortimer, John, talking about behaving, he said, as long as Washington behaves. So then he clarified that meant doesn't raise taxes. And I wonder how much that's sort of an issue that people are looking at.
Yeah, we're still expecting a package that's likely to come with tax hikes. Though, Taylor, I think you nailed it. I think a lot of people feel that way in the bond market. And it depends what your mandate is. But if you're going to take equity risk, most people are going to say take equity risk.
And keep the bonds like the bond-like portfolio. A well-behaved 82 basis points over treasuries on investment grade. Though I have to say, on the back of those comments yesterday on the close, the other comment was, we're still in high yield because there's nowhere else to go.
There you go. Well-behaved seems to be the theme this morning, the phrase of the morning, well-behaved.
Are you saying that?
Tom's watching. That's why I'm saying it. I know what he's up to already. It's 6:40 in the morning. It's not about you.
Tom, not so much.
Don't worry about you. I never worry about you. Lisa Bravitz, Taylor Riggs. I'm Jonathan Ferro. Tom Keane back on Monday. Equity futures 42.60 on the S&P. We advanced by a little more than 1/10%. 149 on 10s. Yields unchanged. Euro dollar slightly stronger. Euro 119.41. And crude just about holding on to a 73 handle. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Emergency crews are combing through the debris of a Miami area condo tower that collapsed Thursday. One person is confirmed dead, but with at least 99 others still missing. Officials in Surfside, Florida fear the death toll will rise. There's no word yet on what caused the 12-story building to crumble. Court records show at least one resident had complained that the Homeowners Association failed to repair damages to cracked walls. Former Minneapolis police officer Derek Chauvin will be sentenced today, capping a murder case that spurred international protests against racism and police brutality. Chauvin faces a maximum of 40 years in prison after a jury in April found him guilty of murder in the May 2020 death of George Floyd. Chauvin knelt on Floyd's neck for more than 9 minutes, ignoring his repeated cries that he couldn't breathe. The UK has added Spain's Malta to its quarantine-free green travel list. The country also said rules will be relaxed later to more destinations for people who are fully vaccinated against the coronavirus. Airline shares gained after the announcement, which will boost the country's ailing travel industry ahead of the school holidays that begin next month. And Iran missed a midnight deadline to renew its temporary atomic monitoring pact with international inspectors. That raises the prospect that it could delete sensitive enrichment information and complicate negotiations to revive its nuclear deal with world powers. Tehran has threatened to permanently delete the information depending on the outcome of wider discussions over sanctions relief. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Haven't gotten vaccinated, this is the chance. This is your opportunity to get immunity before you get exposed, because it's looking like you will be exposed to this virus, so don't delay.
That's the take from Gigi Gronvall there, Johns Hopkins Center for House Security Senior Scholar. From New York City this morning, good morning. Alongside me, Lisa Brambitz, Taylor Riggs. I'm Jonathan Ferro. Tom Keane back on Monday. Here's your equity market. All-time highs coming into Friday. 42.60, pushing 42.61 right now on S&P 500 futures, up by a little more than 1/10%. 10-year yields unchanged, 149.18. Euro dollar, euro stronger. Euro dollar 119.42, up by almost 1/10%. That is a stronger euro. A weaker dollar through much of G10 this morning, with the exception of sterling over in the UK, a weaker pound. That's the cross-asset story. Here's the bank story in the pre-market. Firmer for the likes of Bank of America, JP Morgan and Citigroup. JP up by almost 1%. Bank of America up by 1.35%. Taylor Riggs a green light to pay out a whole lot more.
And we'll get specific numbers, John, Monday after the bell. We didn't think that we'd get them anytime sooner. Certainly the market's excited for not only perhaps maybe some of the buybacks, but a dividend boost as well, John.
Maybe some excitement out there, finally. Maybe some excitement, Lisa, because I see no excitement whatsoever in this bond market off the back of that deal down in D.C.
I love it. And going back to Jeff Mortimer, he said it's resilient. It's a resilient market. Resiliency is the new boring, John. I think that that's going to be our catchphrase.
Well behaved.
Well-behaved
bond market. Andrew Pekos joins us now, Johns Hopkins Bloomberg School of Public Health professor and virologist. Professor, fantastic to catch up with you, sir. As you know, the big story at the moment is the Delta variant. Several studies being done. What are you learning about it?
Well, first and foremost, if you're vaccinated, you should have good protection against this variant of SARS-CoV-2. Some studies from England and ongoing studies from other countries are showing that. Now, if you're unvaccinated, the story is very different. This virus seems to be spreading much faster than even the Alpha variant, which was our big concern during the winter months here in the U.S. And it's showing signs of having more significant disease in younger aged populations. So both of those things are a concern for us. It'll probably be the dominant virus lineage here in the U.S. within a couple of weeks. And that sets us up in the future, meaning in the fall, for a pretty dangerous variant to be around when we think that we'll see surges because people will be moving back inside again.
Dr. Pekosh, from a public health perspective, does the prevalence of the Delta variant, given that it is more virulent, given that it is causing potentially a harsher disease, does it actually edify this idea of perhaps mandating vaccines or being a little more aggressive with requiring a greater proportion of the population to get inoculated?
One of the things that we've seen with these vaccines, and particularly the mRNA-based vaccines from Moderna and Pfizer, are that they've really been resilient. They've taken variants and they've shown to maintain high levels of protection against them. The safety signatures from the mRNA vaccines have been excellent. So that is one reason to really say, yes, we need to move these vaccines into a wider swath of the population. It's a bit confusing to me as to why we're seeing the level of hesitancy that we're seeing about these vaccines, giving all the good news that we're seeing about it. But certainly something like the Delta variant is more urgency to the vaccination. And not to be pessimistic, but we've seen multiple variants, and I'm sure we'll see more coming through. So the vaccines so far have shown resilience, and they should really be pushed to as much of the population, particularly before the fall, as possible.
Yeah, Angela Merkel, just to give you a sense from Germany, saying that the Delta variant means that we can't say the pandemic end is coming. The idea that this is actually delaying when they can project for things to get back to normal. As you were saying, though, Dr. Pekosh, President Biden is saying that he is falling short of his 70% goal, getting all Americans inoculated with at least one shot by the July 4th holiday. We are not there yet. We're at about 65%, 66%. How much do the recent studies about mRNA vaccines and potential heart issues in more than 1,000 Americans, how much is that hampering the PR behind getting some of these vaccines out to the public?
Well, this is where communication becomes incredibly important. We've heard a lot about, most recently, the cardiomyopathy, particularly in young males. We have to remember, though, that those are incredibly small numbers, given the number of vaccinations that have been given out. And it's also a reminder that we actually see cardiomyopathy, particularly in males, every year. We just don't look for it as carefully as we do now that we've got these vaccine trials going out there and we're monitoring for vaccine safety. So I think that message has to be tempered in that safety is being monitored. We're paying attention to any kind of signatures that might come up of adverse effects or bad side effects. And what we're not seeing is a major surge in these adverse effects. So again, the vaccine is behaving quite well in populations. The monitoring is finding very low-level effects. So we're doing our job in terms of the public health community, in terms of monitoring for safety and showing that these vaccines are safe.
What are you seeing in terms of the Delta variant between the Johnson & Johnson one-shot versus mRNA and efficacy?
The Johnson & Johnson vaccine and the AstraZeneca vaccine both have slightly lower efficiency against infection with the Delta variant, but it seems like both of them protect very well from hospitalization and severe disease. And again, that's the most important thing we want from a vaccine. We want to limit those surges of people going into hospitals and dying from SARS-CoV-2. So given the choice, any of them would be fine. But I think this is a good reminder that we're talking about the Delta variant and a
bit of a connection issue there with the professor. We've got to let him go because time is almost up. I'll say thank you to Professor Andrew Pekosh there, Johns Hopkins Bloomberg School of Public Health professor and virologist. And turn to some breaking news in the last couple of minutes. A headline crossed on a Bloomberg terminal, and Virgin Galactic is absolutely flying in a pre-market, up by 7.8%. Here's the headline for you. Virgin Galactic gets FAA approval to fly customers into space. The FAA confirming the May 22nd test flight performed well. They get the FAA okay to fly customers into space, and they get the okay, Lisa Bramlitz, for a full commercial launch license.
Yeah, they got a commercial license back in 2016. That's still in place, but they are now cleared to carry the likes of whoever wants to go up into space. I wonder what the cost is going to be, and I wonder how it's going to be advertised, or is it just going to be such a clamor of people who want to go up into space?
Well, I can say this morning we're lucky to have one of our resident space experts in Taylor Riggs joining the program. Space, Taylor Riggs, Virgin Galactic up by almost 8% in the pre-market.
I would definitely pay any amount of money to go to space. Unbelievable, John, as we're reading through the press release, they're talking about how that May 22nd test flight achieved all objectives. Of course, as we know, the first time that the FAA has issued something like this. That flight on May 22nd, you reach a speed of Mach 3, an altitude of 55.5 miles, and they go on to continue. Just incredible, the ingenuity that we continue to see in these programs.
Do we have a price for a ticket? Do we have any idea?
It probably is not that expensive, right?
Not too. Oh, you don't expect this to be cheap, do you?
I've heard long term it could come down to 6 figures.
Okay.
That's coming down to.
Up by 7.6% in the pre-market. One to watch going into the opening bout. From New York City this morning, good morning. This is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You're going to see prices continue to move up, and it's going to be on the things that we consume.
The economy, at least in the short term, is overheating.
There's always probably too much Fed speak. I mean, the thing to pay attention to is really the chairman.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained,
He's just been saying essentially, wait, look, and we'll respond if we need to. But there ain't no inflation problem.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We have a deal down in D.C. from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Taylor Riggs stepping in for Tom Keene. TK back with us on Monday. Your equity market, 42.62 on the S&P 500. Lisa, we've said it through the last 60 minutes. We have a deal down in D.C. Do we have something that might reshape this bond market?
Not necessarily, not if anything is giving signals this morning. Right now in the bond market, it's a snooze fest, still pricing in lower long-term growth, lower inflation over the longer term. And frankly, nothing is shaking that, even a $579 billion infrastructure deal in Washington, D.C.
Taylor Riggs, 10s 149, 30s 2.1%.
Unbelievable. The well-behaved bond market, John, that we continue to discuss with a 280 basis point spread over the high yield market over treasuries. And we've been having this conversation in the last hour. Hard to go anywhere else, right? It's the only place with yield. And particularly, you take a look at the equity markets, further record highs, S&P, NASDAQ 100.
Let's look at those record highs right now. Your S&P 500 coming into Friday, record high, all-time high. The S&P right now pushing 42.62 on S&P 500 futures, up by almost 6 points, advancing by a little more than 1/10%. Yields, there they are. It is tumbleweed rolling through the bond market. Your 10-year, 149. Your euro, a little bit stronger. Euro dollar, Lisa, 119.45. Stronger by a little more than 1/10%.
So what will it take for things to become a little less behaved, if we want to use the rhetoric of this morning? And the question is, what inflation prints do people care about? Core PCE, the PCE deflator, is the key metric that the Federal Reserve looks at. We're going to be getting it in about 90 minutes time. The expectation is for about 3.5% year-over-year increase in this core PCE metric. The Fed is looking for a target of 2%. Expect people to dismiss that higher number, that higher figure, as transitory. And yet, at what point will enough of these higher inflation reads lead people to say, you know what, perhaps the economy is running a little bit hotter? I'm also interested in seeing personal spending and the shift from buying goods to buying services. And people are looking at the decline in buying stuff and actually being offset by going out to eat and buying services. Then today, we also are going to be getting a roster of Fed speak. But before we do that, 10 a.m. consumer sentiment coming out, University of Michigan. The expectation here is for inflation expectations for the consumer to come down and continue to from some of the high elevation that we saw earlier. This actually will be a determining feature going forward with respect to where inflation goes. Then we're going to be getting a roster of Fed speak, as we were saying. The question is, who do you actually pay attention to? Neil Kashkari, Loretta Mester, Eric Rosengren, John Williams, all coming out. John Williams, however, the one to pay attention to. This, according to former New York Fed President Bill Dudley, who came on the show yesterday and said, all these other guys, it's just noise. There are three big ones. Those are the ones you should watch. Fed Chair Jay Powell, John Williams of the New York Fed, and Rich Clarida, Vice Chair.
You're paraphrasing a little bit, aren't you?
I am.
Just a little bit. Bill Dudley also said something interesting, Lisa, that got my attention, that if you stick to the same message, you can start to marginalize yourself on the FOMC if other people aren't coming with you. Do you think that rings true for any of these guys today?
I think that it's been, you mean Neil Kashkari, Loretta Mester, and Eric Rosengren, the people on the periphery.
For any of the Fed presidents.
Well, the issue to me is they don't want to be subject to groupthink. They want to demonstrate that they are aware of inflationary pressures, that they are aware of financial risks. So at what point is it a positive for the Federal Reserve, even Fed Chair Jay Powell, for some dissent, for some alternative opinions, just so that people could say, look, they're not tone deaf. They're still recognizing what we're seeing, and yet the message is being sent very clearly from the leadership, the trifecta, that we're not going to move anytime soon. So perhaps they're actually dovetailing this and executing kind of perfectly, John.
Dissent is a healthy thing. We cannot accuse the team over at Virgin Galactic of groupthink. Space in the pre-market, the ticker SPCE for Virgin Galactic, up by more than 12%. Taylor Riggs off the back of this headline, Virgin Galactic gets FAA approval to fly customers into space.
Huge, and they're coming out in their press release and saying that they're still on track to do that first flight this summer. I'm still trying to figure out who got that $28 million Blue Origin bid, of course, as you get rival billionaires trying to go into space, John. But for today, it looks like Virgin Galactic, they do it.
Bidding to go into space is one thing. Bidding to go into space and spending some time with Mr. Bezos is another thing altogether, isn't it?
A cool 11 minutes.
A cool 11 minutes. Don't you get to train with him at all? Do you get to do some training with him? I would have thought you did.
I just like that they said that one of the best features was the first class seat with reclining chairs for a good window view.
There you go. Nice. 45.40 of Virgin Galactic. We're up by almost 13% now in the pre-market. Let's turn to Daryl Krog, Wells Fargo, Wealth and Investment Management CIO. Daryl, don't worry, I won't turn to space. I want to turn to this bond market. It's far more boring. Yields are doing nothing off the back of this supposed deal down in D.C., and we've spent the last 60 minutes talking about it. Why do you think that's the case, Daryl?
I think it was largely expected, John. I mean, I don't think there's anything there that's new. This is all about process, protocol, and negotiation. This infrastructure deal is tied, obviously, to the bigger reconciliation deal. Both have to come. The House has already said, along with President Biden, that if we don't get a deal on the reconciliation side, we're not getting the hard infrastructure package. So I think the bond market largely expected that. July is going to be a busy month, though. I mean, you literally have the hard infrastructure package that will need to take flight. You're going to have to start to deal with the fiscal 22 reconciliation budget, which is how the bigger deal on green energy and everything else is going to come through. That probably has a $3 to $4 trillion ticket associated with it. The child tax credit checks are going to hit everybody's checking accounts on July 15th. And as Janet Yellen pointed out yesterday, we have to start dealing with the debt ceiling coming up through the summer and fall. So it'll be a busy summer down in D.C., and the bond market, I think, will have to pay attention through the summer, even if they're not paying attention to that.
Where's the balance of risks right now, Daryl? Is it the potential of a torpedoing of the fiscal support that we're seeing in Washington of some of the infrastructure spending, or is it in a deal getting passed that is bigger than expected, akin to the reconciliation currently being proposed?
I think it's a great question, Lisa. I think it's on the latter, right? I mean, so you still have, for example, Senator Sanders pushing for up to a $6 trillion price tag on that green infrastructure in the second reconciliation bill. It's likely the number, again, is more 3 to 4 trillion. But if that number really starts to take flight and get support, right, bipartisan support where it looks like it's passable, then I think the bond market has to pay attention. I think you get some bear steepening in the curve once again from this anemic, dull, as you guys put it, well-behaved. Today is the last day of school in New York City, so well-behaved maybe is a good analogy for the children getting out.
Or bad.
Right, exactly. So, but no, I think the bond market will have to pay attention. It is a little surprising how quiet and just well-behaved it's been, though.
But is the high yield market, I heard a commentary yesterday, high yield starting to act like equities. So if you're going to make an equity-like investment, just buy equities. Is your high yield starting to act too much like an equity?
Well, there's always been a good correlation there, Taylor, between high yield and equities, right? So I don't know that it's something new under the sun. What I would say is our preference would still be to own equities. We think there's greater upside. There isn't the cap that high yield gives you. And, right now, high yield is just a place to carry on, right? You're getting nice spread along the curve in a quiet bond market with nothing. So you're getting paid well to sit. But it's not an easy case to make that the high yield market is cheap, right? In fact, it's quite expensive with where credit spreads are. So if I have a preference, if it's an or conversation, I have to choose equities over high yield right now. But, in most portfolios, I don't think it's an or, I think it's an and. It's just you want to be up on the high yield spectrum as much as possible, even though you're in the junk space.
Is there a cyclical bias, Daryl, to your equity positioning right now still?
Absolutely. We even with this latest growth resurgence, right, we still think that it's reflationary cyclical bias. So on the equity side, we absolutely, favorables are financials, energy, industrials, materials, communication services. We'd fade the defensive side. You still have early cycle dynamics, John. I mean, I could go through a list and check them off one at a time, right down the list of all the things that mirror early cycle dynamics. The only one that you could even argue might be mid-cycle dynamics is a Fed that's starting to discuss 2 years out plus, this idea that they may raise rates. That's more mid-cycle. But again, 2+ full years away, I just don't think that that's something that we need to terribly worry about at this point. We need to, as they always say, have the party before you treat the hangover here.
Well, Daryl, there is a question, though, when you talk about still going into cyclicals, in particular financials. What's already been priced in? What needs to happen for that to continue, especially given that after it was clear that the biggest banks, 6 biggest banks, could release more than $100 billion with dividends and share buybacks, that the shares are up, 1% max? I mean, this is not a big rally. Is everything priced in? What could potentially push valuations that much higher?
Yeah, I think it's a great point, Lisa. So the stress test results last night were largely priced in, and everybody knew that it was going to be a good outcome. There's estimates that banks could release up to 15% of their market cap in the form of capital in upcoming buybacks, dividends, and the like across the industry. So that's really good news. I think what you'll really see is two drivers for particularly financials. One is you have to get the yield curve bear steepening again. Rates have to go up, which continues to put a tailwind in financials. And maybe as important or more important, I want to start seeing some of the reserve releases, right? Once they start releasing those reserves that they built up through the pandemic, that's going to go straight to the bottom line of earnings, which is going to drive strong earnings growth. I think the headwind on the banks is probably the sales and trading side, right? Because trading has been anemic in this well-behaved, dull fixed income market and the like. So they're not going to be able to push the big banks that have the sales and trading exposure will have some anemic numbers probably in the next quarter or two.
Hey, Daryl, good to catch up. Enjoy the weekend, sir. A long summer weekend, I hope. Daryl Cronk, Wells Fargo Wealth and Investment Management CIO. Summer Fridays, Lisa. When do they start on Wall Street? About 11:30? 10:30?
I was going to say Wednesday.
Start on Wednesday.
Yeah, that's what it seems like in the market.
Wednesday afternoon.
Really well behaved.
Really well-behaved bond market.
Yes.
Look, that's the theme right now that we've been discussing over the last 60, 70 minutes. 10-year yields doing nothing. Off the back of this conversation down in D.C., we have a deal. Yields, 149. Then we turn to the banks. Let's look at the banks right now in the pre-market. Off the back of what could be, we could see $140 billion returned to shareholders for the 6 of the largest banks in America as soon as Monday after the close, Lisa. And I've got to say, that's a shrug too, up 0.9% on B of A.
Yeah, it's nice. People are, thank you for that $140 billion.
Very much.
Yeah, that's it.
Lisa Bravitz, Taylor Riggs, Jonathan Ferro, TK back on Monday. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. Vice President Kamala Harris heads to the U.S.-Mexico border today. She'll tour a customs and border protection facility in Texas and meet with immigrant rights advocates. Her visit comes after months of criticism from many Republicans, as well as frustration from some Democrats for not having gone to the border after President Biden picked her to address the root causes of migration from Central America to the U.S. The bipartisan $579 billion infrastructure deal faces a complicated path in Congress. President Biden told reporters Thursday he expects Democrats to push through an even larger bill with more spending alongside the bipartisan legislation. But many conservative Republicans plan to fight both the bipartisan and Democratic written legislation, and some liberals say they won't support one without the other. Officials in India rejoiced earlier this week when the nation hit a single-day record by administering more than 8 million COVID-19 vaccinations. But that pace still may not be fast enough for India to head off a third deadly wave of the virus. Officials are also questioning whether the faster rate of vaccinations can be sustained. Despite the increased push, only 4% of Indians are vaccinated. Hong Kong's top security official will take over the city's #2 spot in a cabinet reshuffle. It's the latest sign that a crackdown on dissent is central to China's long-term plans for the Asian Financial Center. Security Secretary John Lee has been promoted to Chief Secretary for Administration. Earlier this week, a campaign led by Lee forced Apple Daily, the city's biggest pro-democracy newspaper, to shut down. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
个人目标，可能会接下来会继续锻炼身体，会尝试去做7+2，再次感谢，曾经给我力量、给我能量的艾瑞克。
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This bipartisan agreement represents the largest investment in public transit in American history. We're going to do it all without raising a cent from earners below $400,000. I expect that in the coming months this summer, before the fiscal year is over, that we will have voted on this bill, as well, the infrastructure bill, as well as voted on the budget resolution.
The President of the United States there on an agreement down in Washington, D.C. From New York City this morning, good morning. Tom Keene back with us on Monday. Alongside me, Lisa Abramowitz, Taylor Riggs. I'm Jonathan Ferro. Your market. All-time highs at a close on Thursday on the S&P 500. Futures right now, 42.60, up by a little more than 0.1%. Yields unchanged. The phrase of the morning, a well-behaved bond market, 149 on 10s. In the FX market, euro stronger. Data out of Europe this week, pretty decent. The confidence numbers, the PMIs, better than expected. Euro dollar approaching 120 again, 119.44, stronger by about 0.1%. And a stock mover of this morning, it goes to Virgin Galactic Space. Look at this, 11% higher on my terminal right now in the pre-market. Space, Virgin Galactic, getting the FAA approval, Taylor, to fly customers into space.
And maybe, John, as soon as this summer, I have a viewer writing in. They would like us to report live from air on space. Somehow we have to get a ticket.
Is that an insult or a compliment that they want us to go there and maybe never come back? Your viewers, Taylor, might be nicer than some of ours. Maybe so. Virgin Galactic up this morning by 10, 11, 12%. I'm losing count. The headline that crosses the Bloomberg, significant. It looks like this. Virgin Galactic getting FAA approval to fly customers into space. That stock now up by a little more than 11% in the pre-market. We've got to turn to a deal down in D.C. and bring in Jack Fitzpatrick, Bloomberg government reporter. Jack, great to catch up, sir. When we say we have a deal, let's talk about the we. Who is the we?
Right now, the whip count is probably at 21 senators. There was a deal negotiated primarily by a group of bipartisan senators, 10 senators talking to the White House. They basically have the backing of a 21-person group in the Senate. Clearly, they do have a ways to go, one, to get to 60 votes in the Senate. But the bigger issue is the number of Democrats, including Speaker Nancy Pelosi, saying this deal should go nowhere until there's a second deal, this reconciliation bill, the Democrat-only bill, really, that gets everything else they want on the family plan issue that Biden proposed, on climate, potentially things on Medicare, as Bernie Sanders has called for lowering the age of Medicare. So when Speaker Pelosi said yesterday, this infrastructure bill isn't even going to get a vote until we get that second bill, that really creates sort of an uphill battle, even for this bipartisan deal.
Jack, am I getting this right, that you've got a bipartisan group of senators crafting the $579 billion deal, and then you have a group of Congress members saying, we're not going to vote in that unless Bernie Sanders crafts a $6 trillion bill that will also get passed in tandem? Is that kind of what we're looking at here?
That is kind of what we're looking at, although does it really need to be $6 trillion? That's still an outstanding question. Things will probably come off of that. Sanders has put out his wish list, which is bigger than the collection of Biden proposals. So right now, the conversation that includes progressives is it possible to get the American Families Plan, tax credits for families, plus the climate stuff that isn't in this infrastructure bill, plus a lowering of the eligibility age for Medicare and an adding of the dental and vision and hearing to Medicare. That's a big price tag, but a number of things could fall off of that. So
Jack,
it doesn't need to be $6 trillion necessarily.
Based on your knowledge of Washington, D.C., how realistic is it for this to get done, as Democrats certainly are hoping for it to get done with the reconciliation in tandem with some sort of bipartisan token chip that people can go back and say, hurrah, we all did it, we worked together?
It's possible. Keep in mind, a lot of the time for a big legislative push, it's going to go through reconciliation anyway. The $1.9 trillion stimulus went through reconciliation. Democrats know they only have so many chances to get the things they want. Even Joe Manchin is very open to a reconciliation push after this. So I'm not sure they necessarily lose a lot of votes. It's possible to see all 50 Senate Democrats stick together on this next big package, which would then pave the way for this first bipartisan package. But it's difficult. It's not nearly as simple as just saying they have a deal, all they need to do is pass it.
Now, paying for it, we heard the president, of course, coming into this segment, no taxes as of yet being raised, but eventually, how do we start to pay for it? What are you hearing?
So it's not tax increases. It's some things that I think are going to get some criticism for being a little bit gimmicky. There are extensions of things that are current law but that are set to expire. There are customs fees that in statute are set to expire, and they would extend those. There's an extension of the sequester of some mandatory spending that they tend to extend and extend and extend in perpetuity to use as a pay-for. There are a number of things that aren't tax increases and aren't the gas tax that they talked about. They were a little light on detail in yesterday's announcement on this, but there is going to be some of it paid for using unspent money from the last stimulus. Some of it, they say, accountability on unemployment spending. So if that can be pared back, checking for illegal or inappropriate payments or something along those lines. But it's not the real pay-for as you'd expect necessarily in the sense of tax increases.
Hey, Jack, good to see you. As always, down in D.C., Jack Fitzpatrick, Bloomberg government reporter. Here's some of the pay-fors: stronger enforcement of tax collections, unspecified public-private partnerships, and always a favorite, Lisa, unspecified private partnerships, together with the greater economic growth that it will create. I always love that last bit. To what degree is that true?
Well, the bond market is saying, nope, we're not seeing it. And I think that that's actually really telling, that basically people are counting on faster growth and the bond market is not reflecting that. How much is Jeff Mortimer right? The idea here that potentially the upside surprise of a deal getting passed could lead to perhaps increased longer-term growth expectations, but right now, not seeing it.
Have we just become desensitized by massive numbers in the bond market, south of 150 on 10s, as we're talking about throwing around trillions? Lisa, that's the bond market. Taylor, for the banks, we're talking about Monday after the close, maybe returning $140 billion to shareholders at 6 of the largest banks in America. Basically a shrug in the pre-market too.
huge buybacks, maybe some dividend increases. I believe it was B of A earlier this week that said, what, another $120 billion in buybacks coming this year? It is the year of stocks, was the headline.
Peak everything seems to be the theme.
Well,
Lisa.
I'm sorry, you're looking at a NASDAQ up 11.9% after last year's incredible rally. A lot of this is priced in.
Your S&P 500 all-time highs coming into Friday. Right now, 42.61 on S&P 500 futures, advancing a little more than 0.1%. Yields unchanged on 10s, 149. Euro dollar, 119.43. A stronger euro. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide. Good morning to you all, live on TV and radio. Here's the price action. S&P 500 futures 42.61 on the S&P. All-time highs coming into Friday. We add just a little bit of weight to the benchmark, up about 0.1%. Similar story on the Nasdaq. It's interesting to me that you can take two banks, Credit Suisse, Bank of America, and at Credit Suisse you've got a year-end price target of 4,600. At Bank of America a year-end price target of 38. But they do agree on some things about where you might want to be in cyclicals. They agree on the banks, and you'll find so many people in agreement on the banks to stay positioned and stay bullish. But you need the bond market to come along with you, arguably, and this is what is happening right now. Switch up the board. In the bond market, just a shrug, even as DC talks about spending more and more money on things, good initiatives, like infrastructure. Yields right now south of 149 at 148.84. Your 30-year yield just south of 2.1%. And our theme of this morning, not just a well-behaved bond market, but peak everything maybe. Peak everything. When you're talking about $140 billion getting handed back to shareholders of six of the largest banks in America, potentially, I emphasize potentially, and bank equities not really doing much off the back of it. When you talk about trillions being spent down in DC and your bond market not doing much off the back of it, you've got to listen to the price action. What's it telling you? Let's finish there, on the bonds at least, and finish on this in the FX market. This from Kit Jukes of SocGen this morning. Bit of a snoozer over at the Fed maybe for you. Perhaps you're in the Williams, Clarida, Powell camp, that they don't do nothing for a long, long time. I'll rephrase that. They won't do anything for a long time. Excuse my slang. And for that reason, Kit Jukes of SocGen is saying, look to the central banks that are doing something or are at least talking about doing something. For that reason, long the Canadian currency, stay long the Norwegian currency, and stay long and strong the Kiwi in New Zealand. Just something to think about in G10 right now. That's a story cross-asset. We've got to talk about some movers off the back of this infrastructure deal, if we can call it that. Haven't we, Taylor Riggs?
Well, not a deal yet, but at least an agreement, right? And that is a start. And so you're seeing Caterpillar and some other construction-related stocks really start to move yesterday. You start to see them again moving in pre-market. Also, take a look at Vulcan Materials. There's Martin Marietta. Those are getting some big upgrades from the street. I've read at least 3 analyst notes saying that this deal is a big deal for these stocks. And finally, EVs are also getting a boost in that infrastructure deal as well. So Plug Power moving higher. And yes, space. We're still doing fundamentals here, and I'm petitioning that Bloomberg TV go to space via Virgin Galactic on the news of the FAA approving of customers, of course, going into space. Let's change the board, John, and take a look at some earning movers. Nike at a record. They're saying that revenue could top $50 billion this year. FedEx, though, to the downside, analysts not liking that, hinting at a smaller margin, stepping up those spending pressures that's going to pressure that profit outlook. And then, John, we have to talk about the rebalancing that's happening today. Russell, 1,000, 2,000, 3,000. After the closing bell, we're going to get a hint. It's the last Friday of June. It happens every year. We hear GameStop will indeed be moved up. Take a look at this. Goldman Sachs expecting 255 additions to the Russell 3000, 57 to the Russell 1000, and 279 stocks to enter the Russell 2000. So you're getting a shift, a rebalancing after the bell.
It's been amazing, Taylor, to see the likes of GameStop already, the number 4 weighting in the Russell.
No.
AMC, the number 1 rating in the Russell right now already, Taylor. Just remarkable.
And what does it mean for future volatility? We were speaking with the head of the FTSE Russell, who helps constitute some of these rebalances. Of course, very clear that she wasn't going to speak about individual stocks. But one of our questions was, when you have the top 5 stocks in the Russell 2000 that are all meme stocks, what does it mean for future volatility? It is a question that we will try to answer after the closing
Given
bell.
how many equities are in the Russell 2000, 0.7% is what the number 1 weighting makes up at a Russell. So, Lisa, maybe it's not as big a deal as some people might suggest.
Yeah, although it definitely highlights the peak everything kind of feel that we have right now, given the fact that a company that not so long ago had been basically rejected as having an obsolete business model is now the number 1.
Do you think it's still an obsolete business model?
I think that it depends on what they can actually do with the equity offerings and the money that they've raised in the bond market. I mean, can they come out and make themselves a formidable competitor with the likes of Amazon.com with a smaller pool of potential items for sale? I don't know the answer to that.
You're very diplomatic this morning.
Do you want me to kind of create more?
I prefer the Lisa that has an opinion, does not sit on the fence and tells you what
I think, okay, you want to know what I'm really thinking about GameStop?
I would love to hear it.
Right now, I'm not seeing necessarily the personnel or the strategy that's going to give them the boost longer term. That said, I think that the one silver lining could be that they can raise money cheaply to give them a chance to compete and to survive. And the question is, are they going to use that? And we haven't really seen that strategy or even the personnel at the top to do that. So that, yes, it is diplomatic because it's a wait and see, but I'm not seeing it yet.
Credit investors have had quite a ride off the back of this, haven't they?
Yeah. And they've had a great ride off of the back of this because, frankly, the more equity they raise, the better it is for the debt investors. And can they cash out before it turns south?
Let's talk about crude. That's been heading north over the last several months. WTI, $73 and about 10 cents. Brent crude, $75.41, getting comfortable around 75. I want to bring in Amrita Sen, Energy Aspects founder and director of research. And Amrita, I want to start with the resiliency that we're seeing in the crude market that maybe we haven't seen in the commodity market elsewhere. We've had some big run-ups elsewhere, particularly in soft commodities, agricultural commodities, and a lot of that has faded. Haven't seen that in crude. Why not, Amrita?
Well, because crude didn't go up as much as the other commodities late last year and even early this year. I mean, if you think about it, where copper ended up, equivalent crude should have been $200 per barrel, and it didn't. Crude was the laggard last year because COVID obviously disproportionately impacted crude because it was a mobility issue. And now crude should be outperforming the rest of, well, pretty much all other asset classes and commodities, precisely because, economies are reopening and we are, going about our lives as much as possible. There's still differences in parts of Asia versus the US and Europe. But yeah, I think that's the key thing. The normalization should be benefiting crude more than anything else.
Amrita, I got to channel Tom Keene and talk elasticity here. The idea of how much production is coming back online to meet the demand that is increasing. And you point out in your expectation that Brent will reach $80 a barrel from the current $75.43 by year end, simply because of the lack of elasticity, the fact that the Iranian demand in particular is not going to come back online as quickly due to some recent geopolitical developments. Can you talk about why that is the swing factor right now?
Well, the biggest reason why Iran is a swing factor right now is that we know that demand is rising quite quickly over the summer. We are all going traveling, or at least everybody hopes to be going traveling, and the only group that can really increase supplies is OPEC or OPEC plus, other than Iran, right? And obviously Iran is within OPEC, but because of sanctions, they aren't really able to increase production. Non-OPEC supplies, including US shale, after what happened to prices last year, there's been no investment, and that's why non-OPEC really isn't responding and can't increase production. So all eyes are on OPEC plus, who are meeting on the 1st of July. And we had expected Iranian barrels to start coming back to the market around now, June, July onwards. Clearly, there's been delays. The talks are, we still think it will continue, even though Raisi, who's a conservative hardliner, has been appointed the new president in Iran. But it doesn't look like Iran will be able to come back to the market, or at least a deal is unlikely before August, which means Iran's return is sometime in Q4. Which means OPEC plus have to start raising production this summer. Otherwise, prices could go well north of $80. We do think they will do a little bit for August, but that's the tension you have in the market, that yes, there are supplies available. It's all within OPEC or OPEC plus, but they are sitting on that spare capacity, but they need to be willing to give production to the market. Otherwise, it's a moot point.
So why do you think that Francisco Blanche isn't correct over at Bank of America when he says he could see crude getting all the way up to $100 a barrel?
Well, I don't think that's incorrect at all. It's the timeline of it. I think we've probably been the most bullish on the street for the longest, but for us, it's been 2022 onwards. And we put that forecast out a good year and a half ago, saying that oil prices will go well above $80 from 22 and could touch $100 as well, precisely because of the lack of investment that we are seeing in the market, and COVID has accelerated the move towards transition. I know a lot of banks are catching up to our view on that, but I think the reason we disagree for the short term is that OPEC plus do still have capacity in their armor to give. And if you saw headlines from India yesterday, consumer countries are pleading with OPEC plus that inflation is becoming an issue. And Prince Abdulaziz actually did, at a recent industry conference, highlight that OPEC plus need to do something to make sure that inflation doesn't go out of hand. So that's why it's unlikely that we're going to get a huge surge this summer. Prices will be high, no doubt about that. But until and unless unless we exhaust the spare capacity, which will happen next year, you're unlikely to get prices significantly towards 100 or higher than that.
What is the willingness, though, as prices move higher, for producers to not get tempted by the price and want to produce more?
Well, I think that's kind of been the old OPEC, right? The whole concept of cheating and just lower compliance. And to be honest, we have built some of that in our balances already. That temptation will always be there. But I think this time around, there's two things we are seeing. One, Saudi Arabia under Prince Abdulaziz has really managed to keep group cohesion and compliance high by really explaining to them that, look, if you cut production, you get a higher price, so your net revenues go up. I think he's really done a remarkable job in that. But secondly, a lot of OPEC plus countries, including the likes of Nigeria, potentially Iraq, and even Russia, they are struggling to raise production, we are seeing in the latest data, because they aren't immune to decline rates. And given what happened last year, there's been no investment anywhere in the upstream, right? Not just in non-OPEC countries. So I think that's also helping in tightening up the market, because nobody's able to increase production even if they wanted to. It's only Saudi Arabia, Kuwait, UAE that can really raise production.
And Rita, forgive me, because I've only got 30 seconds left. We're about to catch up with the US Energy Secretary, and I want to ask this question of you. One of the pay-fors in the deal agreed yesterday was some release of the Strategic Petroleum Reserve here in the United States. What did that mean for you? What's your read of that in the last 24 hours?
Well, I think you are going to get more and more SPR being released from the U.S. They've been talking about this for a while. It's not new, because the U.S. is producing more and it needs less imports, right? So I would look at it from that point of view. But yes, they will still need to retain some SPR because it's about security of supply.
Amrita, great to catch up. Amrita Sen there, Energy Aspects founder and Director of Research. Thank you. Coming up next, Jennifer Gronholm, U.S. Secretary of Energy, off the back of a deal down in D.C. Are we calling this a deal, Lisa? I know they're calling it a deal.
Well,
this bond market, I don't know if this bond market's calling it a deal.
It's a deal. At least it was written, but whether it gets passed.
A deal agreed on the people who agreed the deal.
And it's one part of the deal.
That makes sense, and it's one part of the deal. 148.84 on tens. Lisa Abramowitz, Taylor Riggs, Jonathan Ferro from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. British Health Secretary Matt Hancock is apologising for breaching pandemic rules after being pictured embracing a senior aide, but he says he won't resign from the UK government. His apology came after the Sun newspaper published 2 photos of Hancock with the woman. In a statement, Hancock says he knows he let people down and he's very sorry, but remains focused on working to get the country out of the pandemic. Emergency crews are combing through the debris of a Miami area condo tower that collapsed Thursday. 1 person is confirmed dead, but with at least 99 others still missing. Officials in Surfside, Florida fear the death toll will rise. There's no word yet on what caused a 12-story building to crumble. Court records show at least 1 resident had complained that the Homeowners Association failed to repair damages to cracked walls. Iran missed a midnight deadline to renew its temporary atomic monitoring pact with international inspectors. That raises the prospect that it could delete sensitive enrichment information and complicate negotiations to revive its nuclear deal with world powers. Tehran has threatened to permanently delete that information depending on the outcome of wider discussions over sanctions relief. And Virgin Galactic is 1 step closer to being able to fly customers into space. The company says it's been given Federal Aviation Administration approval following the spaceline's May 22nd test flight. Virgin Galactic says it's moving towards its first fully crewed test flight this summer. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I do believe we're in the middle of a temporary adjustment cycle, during which workers will return to the workplace as schools open and fiscal payments expire, and suppliers will eventually catch up to demand. For those reasons, I expect our near-term inflationary pressure to ease as we go into the 4th quarter.
That was Tom Barkin, the Richmond Fed president. Do we listen to the Richmond Fed president, Lisa?
Not
Is
if
that one we follow?
Not if we listen to New York Fed President, former New York Fed President Bill Dudley.
I'm not throwing shade at Mr. Barkin. Of course, from New York City this morning.
Of course.
Good morning. Alongside Taylor Riggs and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures 42.61 on the S&P 500, up a little more than 0.1%. It's just been a shrug from the bond market at 148.67 with yields unchanged off the back of a bipartisan deal down in Washington, D.C. And we've got a fantastic guest joining us from Washington now. I'm pleased to say the former governor of Michigan, the current Secretary of Energy here in the United States, Jennifer Granholm, joins us right now. Secretary, thank you very much for joining us this morning. I'm about to commit an interview sin, so forgive me. I'm going to start really, really narrow on the oil reserves in the SPR. They're going to be released as part of the pay for. I didn't see in the White House release, and forgive me if you've done it subsequently, how much you're looking to raise from that. What is the number?
Yeah, there wasn't a number in there, probably strategically, because some of this still has to be negotiated. But know that it's not selling off all of the strategic petroleum reserves. It'll be a limited sale to be able to meet the goal, which is the president's goal was he did not want any of these pay-fors, as you know, to raise taxes on those earning under $400,000. He didn't want to see a tax on electric vehicles or a gas tax. So this is one of several elements that were used as a paid-for. And again, it's a limited sale.
Secretary Granholm, it was interesting that the Republicans put out a document circulated by Republican lawmakers that had the number $6 billion in there. The amount of money that they would raise from the sale of emergency oil reserves, as you say, of course, not the entirety, a portion of them. Is that number wrong?
I'm not saying it's wrong. I'm just saying that is, this is a framework that was announced. Not everything is set in stone, and it may move a bit. But the bottom line is it is a limited sale.
Secretary Granholm, how far does this deal get toward moving to an electric future? I'm talking about vehicles in particular, given the fact that there isn't necessarily provisions for taxes on gas, higher taxes on gas, and the provision for electric vehicle charging stations is just $7.5 billion versus the call for $174 billion that Biden originally had for electric vehicle initiatives.
Yeah, part of that 174 was, a big part of it was the point of sale tax, incentives, point of sale incentives for the purchase of electric vehicles so that they are at the same level as internal combustion vehicles. And that's something that the president will still fight for in the second part of the two-step dance that is being done. The first part being the bipartisan part, and the second part being reconciliation, which I'm sure your viewers know is the budget reconciliation process. And in that part, he's going to fight for a lot of the climate-related measures that he put forth in the American Jobs Plan, as well as the measures in the American Families Plan, which involves, preschool. It involves 2 years of free community college. It involves the care economy. So this first step, important, I'll say this, in terms of electrifying the future, is that we have a strong transmission grid. And you saw that there was $74 billion in the power sector, good chunk of that for expanding the capacity, the resiliency of the transmission grid, hugely important for electrifying.
Secretary, are you disappointed by the fact that there wasn't more momentum behind some of these initiatives that would push the United States further toward some of the clean energy goals?
I'm not surprised that this first package, this first framework, doesn't include a lot of that, because it's been difficult to get a lot of tax incentives behind clean energy from the Republicans, but there's a lot of Republicans who are benefiting from it as well. And so in the second package, as the president mentioned yesterday, he's going to continue to fight for those climate measures, including a clean energy standard. So the bottom line is this is just one step, but we got to take the second step as well to get the president's full agenda through.
Some of the items as well that we're looking at, and I harken back on some of my Muni days, Ms. Secretary, about fixing bridges. Of course, we talk about the electrification of buses, but it's more than that. It's updating the airports. It's fixing waterways. It's beyond just the size and scope of an electrification. Are those two, though, enough of a green energy for you?
Well, it's certain. I mean, this is an historic investment in water. So what they're going to do is make sure that every home in America has pipes that are safe to drink from, so that there's not lead in the pipes and so children are not poisoned. Every home in America has access to high-speed internet. It's an historic investment in rail. It's an historic investment in transit, as you suggest. And of course, it's an historic investment in the transmission grid. So all of those pieces are very important for America's future. And frankly, all of them are pieces that the public, whether they're Democrats or Republicans, overwhelmingly support, because who cares whether you're a Democrat or Republican? You want to have water that's safe to drink.
Can we also just talk quickly about the grid, what you can do from a national level? We're coming off of Texas that we just saw. I'm from California. The power goes out in the summer every afternoon. You have to unplug your appliances. You try to go to dinner and they say we're out of power. Too bad. What can we do on a national level to make sure that we are shifting to being more climate friendly, but also maintaining reliability?
Really important question. So what we need to do is to add capacity to the transmission grid to bring the clean energy that's being generated in the states that have a lot of wind and solar to the places that have load centers, which are using a lot of electricity. We have to make sure that we do what the Department of Energy is doing, which is investing in the research that allows for expanded, significant storage movement on energy storage so that we can use these clean energy assets 24/7. But the president also wants to see an investment, for example, in keeping the nuclear plants that we have online open, or investment in next generation nuclear, which is baseload clean power, investment in geothermal, which is baseload clean power, investments in hydropower, which is baseload clean power. All of that has to happen. Not all of that was included in this first piece, but we're going to fight to make sure that all of that is included in the second bit of legislation that we hope will arrive at the president's desk this summer.
We're speaking with Jennifer Granholm, U.S. Secretary of Energy. And Secretary Granholm, there's a question about the shale producers here. Even as we try to talk about a transition to clean energy, shale producers have been behind a huge surge in economic activity for the United States, a huge concept of U.S. oil independence. And now we've seen shale production fall off substantially during the pandemic and not really come back as much, no longer thought of as the swing producers. How important is it, in your view, to get that production back up and running at the capacity that it has versus the discipline that we're hearing out of the CEOs from a lot of these companies?
Well, I think this is a really important question because the world, as you know, is moving to clean electricity, clean power. And natural gas, an important baseload fuel, has some problems with clean. I mean, it is cleaner than coal, certainly, but it has methane emissions, which is a very potent greenhouse gas. It's got CO2 emissions. What's interesting is in the framework that was announced yesterday, there are a significant amount of money for demonstration projects in what is known as carbon capture and sequestration, which could be used to decarbonize the fossil fuel sector. And that, to me, is another very important technological step and a step that helps our climate goals. And it's technology that can be used here, but also help around the world to decarbonize and everybody get to the goal that all these countries have signed on to, which is at the Paris Agreement that we get to net zero carbon emissions by 2050. I think that will help. Those kind of technologies will help for this, for the oil and gas sector, the gas sector in particular, to be able to ramp up production, but in a way that is clean.
Governor, just quickly, just to round out this interview, what's the future? What's the role of the SPR in this administration?
It's an emergency stockpile, essentially. In case we have, obviously, it was something that was generated and particularly important during like the oil embargo and the OPEC crisis.
Is it still relevant?
We have this as an important measure in case there is shortages in case we need to have it, and so we're going to keep it. And in fact, it's underneath the Department of Energy, and we're putting it into a section of the Department of Energy that responds to emergencies.
So why is it being used to raise money? Is this an emergency?
Every year, I'm telling, this is not new. This is not a new thing.
I understand that you do get a release, but to raise money to pay for an infrastructure plan, that feels a little
honestly,
original.
Every year Congress uses it for to pay for something or another that may not be related to the reserve itself. So the reserve will be solid. We've got lots in the reserve. It will continue to be it'll continue to be there for the purposes for which it was intended. But it also has this mechanism that it's being some of it gets sold off every year for other reasons that Congress wants to fund.
And this is one of those occasions, apparently. Secretary, fantastic to catch up. Secretary of Energy, Jennifer Granholm. Thank you. Thank you very much. Energy, a key part of this story, Lisa.
Yeah, although key and a part of the story, the question is how far does it get toward President Biden's goal of a greener energy future? Because right now the infrastructure plan much more focused, as Taylor was saying, on bridges, on roads.
Crude this morning, Brent 75.43, WTI $73 and almost 10 cents. Let's check out the price action. All-time highs at a closing Thursday session this Friday morning. We shape up as follows, just south of 260, 42.60 at 42.59, positive by almost 1/10%. Yields unchanged at 148.84. Your FX market, euro dollar 119.42. We're stronger there on the euro by almost 1/10%. A lot to discuss in this market, particularly for the bond market on what is not happening. What is not happening is a sell-off off the back of throwing around a few trillion down in DC. At least that's the conversation. I say throwing around. I know it's targeted investment.
You said
before I get the emails.
Not happening. Nothing's happening.
Well, that's what I'm saying, Lisa.
Yeah, I know. It's just amazing.
Lisa Bramwitz, Taylor Riggs, Jonathan Ferro, Tom Keene back on Monday. This is Bloomberg.
Morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You're going to see prices continue to move up, and it's going to be on the things that we consume.
The economy, at least in the short term, is overheating.
There's always probably too much Fed speak. I mean, the thing to pay attention to is really the chairman.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained.
He's just been saying essentially, wait, look, and we'll respond if we need to, but there ain't no inflation problem.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's get you to the weekend from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene back on Monday. Taylor Riggs stepping in early for us. Thank you, Taylor. Equity markets, 42.58 on the S&P 500. All-time highs, a deal down in D.C. Lisa, the story of this morning, we just keep going back to it. 148.67 on 10s, unmoved in the bond market.
And this feeling that not much could move it. Not only do we get the infrastructure bill down in Washington that looks like it's getting some power coalescing behind it, but we're also about to get inflation data. No one seems to care. No one's even mentioning it, John. At what point can nothing shake the resiliency of, is it a mid-cycle market, or is it just simply a market pumped up by stimulus dollars?
Well, that's the key. Where are we in the cycle of this market, Lisa?
And that's the key question that a lot of people have different answers to. People saying mid-cycle, that's, I guess, the consensus that seems to be being generated on Wall Street. However, some people saying this cycle has moved so quickly, to your point earlier, such a consolidated credit cycle that we could be entering into a later stage without people realizing it.
Taylor Riggs desensitized to some of these big numbers down in Washington.
Totally desensitized, not only the bond market, but you did see some interesting movements within the equity markets, though, John, as we all know, the smart money, it is in bonds. But the equity markets get a lift yesterday. You saw some movements, some upgrade from analysts on some of those infrastructure-related stocks. Further record highs, I guess it's the place to be.
Potentially. Your equity market looks like this, 42.59 on the S&P 500. Let's whip through the price action. In the bond market, we've touched on that already, 148.33 on 10s. Yields come in almost a basis point on the day.
Wow.
I know, maybe we've been spoiled over the last week, Lisa. Seen so much in the bond market already. Saw 135.
I know.
Monday morning.
I know. Now we're talking a basis point. Look, I think we will get volatility. I think that it just will take a while for people to really get a shift in what the Fed is going to do.
Euro dollar 119.47, stronger euro. Crude with a 73 handle. We hold on to that. We're down about 1/4% on WTI, $73 and about 13 cents. Stock mover of the morning. I know many of you paying attention to what's happened at Nike with some really, really nice results. But space, Virgin Galactic in a pre-market up by almost 15% now, Taylor Riggs. Virgin Galactic getting FAA approval to fly customers into space.
This is unbelievable, John. This is the stock of the day. How excited is this? How does this speak to the ingenuity, right, of science, of how innovative people
Okay,
can
traders,
perhaps
it's time to play stop and profit for Japanese yen.
This summer.
Okay?
Don't forget, you
Let's
have a
play
billionaire
stop
just
and
down the road
profit
as well, Blue
at
Origin,
110, 725.
million, I believe it was.
Okay, it will give us 200 pounds in profit for you. It will give us whatever broker pays you per pip, right? We in Japanese yen case, it's 10 pips. Okay, stay safe,
reaching a certain
trade, and I'll speak to you later after some changes happened with Japanese yen. If it will move lower, we will move our stop and profit as well in our advantage even higher. Okay, guys, stay safe, and I'll speak to you later.
$140 billion and change returned to shareholders of 6 of the largest banks in America. Bank of America up 0.9%, JP up 0.5%. Citi, Lisa, up 0.2%. They get the green light from the stress tests.
Yeah, Citigroup actually had the biggest expectations, and perhaps that's why they're not up more right now. People had expected them to be the winner of the stress test, but still remarkable to me, the little reaction to the idea of $140 billion being released. Peak everything.
That's the theme. Patrick Armstrong joins us now, Plurimi Wealth Chief Investment Officer. Patrick, we talked about it earlier this morning. Peak everything at a market that seems increasingly desensitized to some of these numbers. What's your take on that, Patrick?
Markets are drifting higher, and it's a function of you've got earnings growth, you've got an economy that's still growing. It's not accelerating in that growth anymore, but the pillars of higher risk assets are liquidity, low bond yields that are below inflation, and economic recovery that leads to earnings growth. And I don't think any of that's changed. The dot spooked markets a little bit on Thursday, Friday last week, but while those pillars are in place, I do think the path of least resistance is everything moving higher.
All right, so what's the risk factor that you're watching, Patrick?
For me, I'm worried about a multiple contraction that'll eventually happen on higher 10-year yields. And you've been talking about it all morning, that the 10-year yields are very stubborn. They're not moving higher. But I don't see how 2 years from now we don't have significantly higher 10-year yields. The Fed's going to stop purchasing bonds, and a lot of people say when you don't do QE, that actually suppresses yields because it gets rid of a tailwind for the economy. But I think this time we've got job seekers who really now have some pricing power. If you look at the NFIB surveys, it's a 40-year high of companies finding it hard to fill their job vacancies. The biggest problem companies are facing is that they can't find quality applicants for job openings, things like that. I don't think inflation is going to be transitory. There's a lot of transitory factors that are pushing inflation very high. But if we do get wage growth, which I think is coming, I think inflation is going to be a problem rather than something that other central banks are trying to engineer. And the stimulus package that it looks like we may have some bipartisan agreement on, that's going to come. Whether this bill is what it ends up being, I doubt it. But there is a genuine belief from both sides, Republicans and Democrats, that government spending and infrastructure is something that's needed. So I do think that comes, increases deficits, increases growth with it as well.
With those inflationary pressures, are we also at peak margins?
That's probably a fair assumption. And margins are record highs, just like everything else pretty much. And when you do have higher input prices, you do have higher wage costs. Most likely, companies are going to push that to the consumer in some effect, pushing up prices, but probably going to take a bit of a margin hit there as well.
So Bank of America have looked at things like the employee to revenue ratio, which over the last several decades has declined markedly given the composition of the S&P and how that's shifted towards big tech, which for some of these big companies has a very, very small cohort of the labor force. So Patrick, I'm trying to wonder from your perspective whether you're looking at things like that, whether you break down the market that way?
Very much so. So the services sectors, if it's restaurants and hotels, all of those are very labor-centric. The big drivers of the stock market, though, the technology companies, that's basically the thesis there is moving away from man and moving towards computers and efficiency and productivity gains there. So you get a bit of both sides of those. Margin expansion from the big tech, hard to expect it to go further. Even though they won't be suffering from the higher wages, won't be suffering higher input costs. When you're looking at a 52% gross margin on an iPhone, I don't think there's going to be the ability to basically expand those kind of things.
So when you're talking about big tech, I think about your earlier point that you think inflation on a longer term basis is more of a risk than perhaps the market is realizing it. Can you dovetail your expectation for man versus machine taking a bit of dominance over man with that inflationary call, given the fact that a lot of these tech advancements have been disinflationary?
They are very much disinflationary, and you've had basically a 30-year disinflationary backdrop with basically increasing global trade, getting deregulations from the 1980s, and tech just improving productivity. We do seem to be moving the other way on some of those kind of things. I don't think the tech disinflationary backdrop will change, but without the other things basically adjoining with it, I don't think it's going to be the powerful disinflationary backdrop that we've had. And it's coming down to wages. When people have more money and it costs more to produce a few things, it's going to come through in higher prices. The government needs inflation as well, because when you've got debt to GDP moving well above 100%, it's hard to create real economic growth. It's easier to create nominal economic growth. And if you've got a central bank suppressing yields to some extent, that's probably the best way to manage a debt to GDP ratio.
As we're talking about debt, deficits, you name it, along with the infrastructure package that we're at least getting some agreement on, do you just further assume dollar weakness under the weight of debt and deficits?
I don't think it's going to be markedly weak, but I do think the U.S. has been the most aggressive on what it's doing on deficits and debt, and it's really, that's weak dollar. But on the other side of things, it's got a central bank that will be hiking a couple of years down the line, where the ECB's probably got 5 years where it won't be able to move its interest rate. So I think you're getting a bit of an offset there. I do expect very marginal dollar weakness, which will be, again, a tailwind for risk assets generally, but I don't think it's going to be sharp.
And Patrick, I ask this question every now and again. I want to finish with this question with you. Do you think the ECB can actually hike rates this cycle?
Yeah, I think it's the next 5 years. They're probably stuck where they are, and 10 basis point hike, a token thing, and maybe even getting to zero at some point in this cycle, I would probably view that as a victory for them.
I'd be surprised by
almost impossible. Yeah, me too. It's they've got a big challenge in front of them, and unless you have a very weak euro, which doesn't suit Germany, I don't think necessarily. It's hard to see how you generate any inflation in the Eurozone.
Patrick, good to see you. Good to catch up. Patrick Armstrong, Plurimi Wealth Chief Investment Officer. If you think about the tree-shaped hikes of the last cycle, they came early in the recovery and were largely considered to be a mistake. And Lisa, they were the only hikes of the last cycle in Europe.
I think you could ask the same question of the Federal Reserve. Do you think that the Fed could really raise rates this cycle, given the fact that when they even hinted at tapering, there was that flattening in the yield curve and the decline in longer-term inflation expectations? As Patrick was saying, the United States needs greater inflation in order to repay some of the debt and to actually offset the increase in debt load. It's a similar situation.
So naturally, I won't take a position on it. I will say that Mike McKee has asked the question. I believe he's even asked the question in the news conference, whether the new framework, because it basically ties your hands and forces you to respond late, whether too late could mean not being able to move at all, Lisa. There's two ways of looking at this, that you move late and you have to move quicker, or you move so late that you can't move at all.
Well, the question is really what inflation does, right? And if people think that we're in the same zone that we were in pre-pandemic, and that if anything, it's only gotten more entrenched because of the debt load, then it will be very hard for them to raise rates ever.
Coming up, we've got to talk about these banks. What a man to talk about the banks with. Mike Mayo, Wells Fargo Securities US Large Cap Bank Research Managing Director. We'll do that shortly. From New York City, equity futures up 3, advancing almost 0.1%. Let's call it 4260. A nice round number. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. At least 4 people are now confirmed dead in that collapse of a condo tower in the Miami area. Emergency crews are combing through the debris with dozens of people still missing. Officials in Surfside, Florida fear the death toll will rise. There's no word yet on what caused the 12-story building to crumble. Court records show at least one resident had complained that the Homeowners Association failed to repair damages to cracked walls. Vice President Kamala Harris heads to the U.S.-Mexico border today. She'll tour a Customs and Border Protection facility in Texas and meet with immigrant rights advocates. Her visit comes after months of criticism from many Republicans, as well as frustration from some Democrats for not having gone to the border after President Biden picked her to address the root causes of migration from Central America to the U.S. British Health Secretary Matt Hancock is apologizing for breaching pandemic rules after being pictured embracing a senior aide, but he says he won't resign from the UK government. His apology came after the Sun newspaper published 2 photos of Hancock with the woman. In a statement, Hancock says he knows he let people down and he's very sorry, but remains focused on working to get the country out of the pandemic. And former Minneapolis police officer Derek Chauvin will be sentenced today, capping a murder case that spurred international protests against racism and police brutality. Chauvin faces a maximum of 40 years in prison after a jury in April found him guilty of murder in the May 2020 death of George Floyd. Chauvin knelt on Floyd's neck for more than 9 minutes, ignoring his repeated cries that he couldn't breathe. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning to you all, live on TV and radio. Alongside me, Lisa Abramowitz, Taylor Riggs, I'm Jonathan Ferro, Tom Keane back on Monday. Your equity market coming into Friday, record highs, 42.59 on the S&P 500 right now, advancing almost 1/10%. Yields are unchanged, your 10-year 148.84, and the banks look a little something like this in America in the pre-market, going into the cash open, into the opening bell, off the back of the green light from the Fed stress test. JP Morgan up by about 0.5%. B of A up by 1%. Citigroup 71.65 up by 0.46% in the pre-market this morning. Perfect guest, the man himself, Mike Mayo, Wells Fargo Securities US Large Cap Bank Research Managing Director, joins us now to discuss. Mike, let's start here. After the close Monday, we could get some big capital return plans. What are the numbers that you're looking for, sir?
Well, wow. This was the Fed stress test, and it used to be the Super Bowl of banking. And now it's like a preseason game. It was boring, but you know what? Boring is beautiful for banks. The Fed threw the kitchen sink at the banks with the stress test. The banks passed with flying colors. As you mentioned, Monday at 4:30 p.m., we expect a flurry of press releases that announce increases in dividends.
Okay, traders, let's move our stop on profit even further to our advantage. And I'm going to move stop on profit to 110,695. Okay. Okay, we moved stop on profit. It will give us 5 pips. In our case, it will give us £500 in profit. Stay with me because we didn't close trade yet. So copy this trade, follow me, get the strategy if you want to trade other pairs. All the information you can find on this streamer, on this channel. Also, you can register for July webinar. I'm going to provide webinar on Saturday. It's probably the first time I decided to do webinar on Saturday. So register for a webinar. We're going to talk about arbitrage, how we trade, how we use arbitrage when day trade, what broker to use, what you need to find out from broker in order to trade arbitrage. Okay? I'll speak to you later, guys, and stay safe.
The more of the risk has been outside of the banking industry. So just like there's been skepticism, too much over the past year, there's still skepticism, but connect the dots. I mean, banks passed the Fed stress test. Monday at 4:30 p.m. you get the announcements. Then you get the increases.
No, Mike, hold on a second. I'm sorry. I don't think I hear from a lot of people that they're worried about some sort of systemic risk from the banks. I hear the fact that the yield curve is flattening, that this has been priced in. I mean, are you saying that it's not that people are still worried about systemic risk?
No, I think that's past. That's what happened over the last 6 to 12 months. But now people are like, well, we don't really... We know the dividends are coming, but we don't really care that much. But I think they should care, because if you look at the dividend yield adjusted for buyback should be about 8%. Compared to the 10-year yield of under 2%, that gap is one of the widest in history. Where can you get an 8% yield globally? And in fact, that's 300 basis points above the junk bond yield. So I think people are just cynical and skeptical about the sustainability of banks' capital returns, the sustainability of earnings. And Lisa, you raise a great point. The flatter yield curve is on people's minds. But look what just happened last week. The Fed said now it's likely to have 2 increases in the Fed funds rate in 2023, and banks benefit twice as much from increases in short-term rates as they do from increases in long-term rates.
Mike, you're famous for your calls coming on the program and saying banks aren't financials, banks are just tech companies. Despite all of the buybacks and dividends, are they investing enough to keep up with big tech?
Well, the largest banks certainly are. I mean, some of the best fintech players on the planet are Bank of America and JP Morgan. You have tens of millions of customers, and this is going from digital interactions to digital relationships. They're not just touching customers through one point, but through multiple points, and they continue to invest and they continue to gain customers. And both Bank of America, which is our #1 pick, and JP Morgan grew deposits over the past year equal to the 6th largest bank, and that was organic growth. And a lot of that is aided through digital banking.
Hey, Mike, I've got to run. I apologize for my colleague, Lisa Abramowitz. I'm joking, Lisa. Mike Mayo,
it's okay.
Wells Fargo Securities U.S. Large Cap Bank Research Managing Director. I think you're right to push on this issue. As Mike points out, the numbers are there. We can all see them. Yet the prices, Lisa, are not responding.
And I would just say it seems like the skepticism around financial stability have basically been thrown out the window by everybody other than Senator Warren. I mean, the idea here is the banks have been the stalwarts through this cycle. The question is just the profitability and how much they can generate, especially without the loan growth, because we really haven't seen it.
A shrug of the shoulders in the equity market for the banks, a shrug of the shoulders in the bond market for treasuries, yields 148.84 on the day. Let's continue this theme. We can do that with Republican Congressman French Hill of Arkansas. Congressman, fantastic to get you on the program with us. Can we just start with the infrastructure plan, just briefly, if you may? Looking at these numbers, you would think there'd be a big reaction here in the bond market, and we don't have one. So I want to understand from your perspective, what you've heard in the last 24 hours, what you think can actually be passed down on Capitol Hill in D.C.
I think the moderate Democrats and the Republicans in the Senate have been sort of thrown under the transit bus by their proposed compromise, because immediately upon reaching a constructive bipartisan agreement with the president, Nancy Pelosi and Chuck Schumer said, well, we won't support this at all until we raise taxes on working people and business and pass our Green New Deal and other American family priorities through budget reconciliation. So once again, I think President Joe Biden is a prisoner of the left wing of the Democratic Party here in Washington.
So just quickly, Congressman, just to jump back in, what was agreed yesterday? Dead on arrival already?
Well, the House Republicans proposed a $400 billion surface transportation bill with a pilot program to have vehicles taxed on miles as opposed to the gas tax, which I think is a constructive approach. House Democrats are going to move a bill next week that's basically the Green New Deal priorities of about $570 billion. So it's not dead on arrival, but I wouldn't say that it's being acclaimed on both sides of the aisle and that it's not done remotely yet.
Congressman, what would you be okay with when it comes to reconciliation in tandem with this bipartisan deal?
Well, we need targeted spending, and we need to get back to spending priorities instead of proposing to spend $6 trillion and increase the size of the federal government way up over 25% of our gross domestic economy. We need to not raise taxes on workers and on businesses as we try to come out of the pandemic and get people back to work. So, Lisa, it's really a subject of not only the amount of money, bring that infrastructure compromise approach to a vote until they get a vote on their reconciliation pact, which is a multi-trillion-dollar package with tax increases. That's what the Democrats in the House and the Democrats in the Senate are demanding of Chuck Schumer and of Nancy Pelosi. So I think it's premature to say, well, what does the final package look like?
Does this sort of two-route approach, is that the way to be going?
Well, normally, no. I thought what Joe Manchin thought he was doing with Susan Collins and others was coming up with a way to get a bipartisan infrastructure package with as much pay for from previously appropriated funding as possible and get that passed in a clean way on a bipartisan basis in both houses of Congress. And clearly yesterday, Nancy Pelosi and Chuck Schumer threw a wrench in that plan.
Senator, or Congressman, I should say, you're also ranking member, as we see here, on the National Security, International Development, and Monetary Policy Subcommittee. When we think about the grid as being a national security issue, are we doing enough to really meet both requirements, making the grid reliable, transitioning perhaps to more of a green, energy-friendly, but it has to be protected as well from a national security perspective? Is there enough in this bill to do all of those?
Well, that's been an ongoing priority on a bipartisan basis in Congress, and we have two of the power control, powering, sharing companies headquartered in Little Rock, Arkansas, in my district, Southwest Power Pool and MISO, and in both instances, they have a reliability transfer authority for power across this country that includes a strong cyber protection and grid resiliency initiative. And I've met with those companies and many utilities on it. So the private sector works on this every single day. And where the government can make strategic investments, I think you'd find bipartisan support. As to the amount, that's not something I can comment on today because I haven't studied their proposal.
And we will make sure to ask you as well another question, because we're coming off of a bank conversation that we just had. Of course, the banks coming out and passing, of course, all of those stress tests. Can you confirm that you don't see systemic risk, that the banks passing those stress tests are indeed a positive thing, returning that capital to shareholders?
I think the bank's financial strength through the pandemic has been one of the bright spots that gives us the strength for the economy to know that we can get people back to work and have GDP grow between 6 and 8% this year. So I think that flying colors pass of the stress test indicates our economy is open and ready for business, and I look forward to the results of that by more Americans getting back to a full-time job.
Congressman, just before I let you go, I just want to finish on that. The usefulness of stress tests, if we never allow the banks to face stress again. And the Federal Reserve is seemingly pretty intent on never allowing that to happen. Last year, a fantastic example of that. The banks didn't get into the stress. Maybe that's a good thing, I don't know. But I want you to tell me, what's the value of a stress test if this Federal Reserve is hell-bent on these banks never facing stress again?
Well, I don't agree with zero interest rates that the Fed has proposed, and I don't think they should continue at the rate of $120 billion a month. Those benefit the economy in the short run during the pandemic, but it's time with an 8% projected growth rate to move away from that. But they have a primary obligation to regulate our banks and make sure they have the capital to operate a safe and sound environment, and that's what's been done. And it's been a big change from the 08-09 crisis, and that's why you saw so many street firms convert to a commercial bank charter so they could build the capital and the resiliency necessary if there was an economic downturn.
Congressman, always smart, always sharp, and it's good to catch up, sir. Come back soon.
Thanks,
Republican Congressman French Hill of Arkansas. Thank you, sir. Some economic data about to drop in the United States of America. Equity futures up by almost 1/10% on the S&P 500. Your bond market basically pretty much unchanged and dead flat. Your yield going nowhere, 149.01 on 10s. The euro just a little bit stronger. Euro dollar 119.50. Here's the data. Personal income down about 2% against a median estimate of negative 2.5. Personal spending comes in dead flat, 0.0% from a previous read of 0.5, and a median estimate of 0.4%. Then there's a whole raft of data that drops after that, Lisa. The PCE deflator, the PCE core deflator, real personal spending. Take your pick.
Yeah, the interesting thing to me is that it actually was a disappointment when it came to spending and when it came to the core deflator. The core deflator was pretty much in line, but personal spending, I want to dig more into the numbers to see whether services spending did not offset the decline in goods spending, as we saw. What does that mean, John, in terms of how much of the dry powder in savings accounts people are actually going out there and spending?
Let's hit this data right now with Torsten Slok, Apollo Global Management Chief Economist. Torsten, just pouring through the data this morning, the recent economic data as well. What's your take, sir?
So there are two very important components here. Of course, the first thing to watch is inflation. Core PCE inflation was exactly as the consensus expected, 3.4. So that means, of course, that we do see inflation higher, and that is just confirming what we saw. Remember, we got the CPI numbers already, so that means that we already knowing that this month was indeed a very elevated level of inflation. The second thing is what Lisa just mentioned, this shift away from goods to services. To what extent are we seeing people go back on airplanes, stay at hotels, go to restaurants? The service part of the economy needs to come back, and that is exactly what we're seeing in the data and what we've been seeing. A lot of the high frequency indicators, more people are flying on airplanes, more people are going to restaurants, more people are staying in hotels. So the trend is shifting from goods being a key driver to now moving towards services being a key driver. So those are the two main components of the report here.
Let's talk about how we capture some of those trends. Just run a clinic for us, a short one if you can. For people who tune in every now and again to a show like this and hear terms like CPI, PPI rather, PCE, core deflator, what are all these things, Torsten?
Yeah, so what the key issue really here is to monitor what the Fed is watching. And the Fed has very clearly said that they monitor core inflation, and specifically the core PCE inflation indicator, which just came out. And why do they monitor core inflation, and what does core inflation mean? Well, normally we measure inflation including everything, also including very volatile components such as food and energy. But the Fed has the logic, which makes a lot of sense, to say, well, we don't want to monitor and put monetary policy according to very volatile indicators. So let's instead look at those parts of inflation that are relatively stable, that tells us something about where the economy is going. And core inflation, meaning excluding the most volatile components, meaning food and energy, does represent a very good picture of where is the economy at the moment. And that indicator at the moment is significantly above the Fed's inflation target of 2. And that's where this debate about, now that we're so much higher than the Fed's inflation target of 2, is that something that's temporary? Is that something that's permanent? And that is the discussion that we're having in markets, namely, what are the reasons that one could believe why this could be a more permanent problem?
And Torsten, a lot of people have dismissed some of these traditional metrics of inflation just simply because the composition has changed so much during the pandemic. Services, such a big component of some of these inflation metrics, completely fell out of bed simply because people were not allowed to go out and do stuff. Now we're seeing it come back online. How significant is it for you that in this most recent data we saw a disappointment in terms of services spending, that isn't coming back perhaps as quickly as some people had previously expected?
Yeah, this is very important. Think about it. CPI, or inflation, is measured as the basket of consumption that we all have every month. So if my consumption changes during the pandemic, I don't fly, I don't stay at hotels, I don't go to restaurants, of course I will spend less money on those components, and those components are mainly services. So that's why during the pandemic, people spend a lot more money on goods and much less on services. That's changing now. So that's why from a basket perspective, and exactly as you're pointing out, it becomes relevant to monitor whether are we seeing prices go up of airline tickets, of hotels, of restaurants, which is exactly what we've seen in the inflation data. And that's what has been lifting the level of inflation to this much higher level relative to where the Fed's target is. So that's why over the next several months, we need to monitor very carefully whether the services component, in other words, the reopening parts of the economy, continue to see high inflation, which is what Jay Powell earlier this week also was pointing to. So he's saying this is all temporary, but there are some reasons to worry that this might be more permanent. Commodity prices, if I type CRB, go on my Bloomberg screen, I see commodity prices still very elevated. I also look at, of course, the labor market being still very tight. And of course, also the supply chain problems. If you look at the regional Fed surveys, also show a lot of persistent problems with supply chains. So there are some reasons to believe that this is not just going to be a few months and then inflation comes down. So that's why the discussion, in particular for rates, is all about this issue. How long time is this inflation problem going to persist?
We're speaking with Torsten Slok, Apollo Global Management Chief Economist. You came to this buy-side firm from the sell-side firm of Deutsche Bank, where you ruled over the economics team for a long time. And now you actually have to put this into implementation and help them direct their strategy. And I'm wondering, given the details that we're getting out here, is your view that the market is right, that it is risk on low rates in perpetuity because the signs of longer-term inflation, I hear what you're saying on commodity standpoint, but when it comes to the deployment of some of the cash that people have in savings account, there hasn't been a sign of some sort of massive rush that can outweigh some of the higher prices that might keep people from spending too much for too long.
Yeah, from an investor perspective, I mean, it's very clear at the moment the level of long rates is very low. The level of short rates is very low. The credit spreads across the board, IG, high yield loans are very, very tight. Stocks are basically at all-time highs. So with that backdrop, it does become very important to think about if there is an inflation risk, if there's a higher likelihood that this cloud that we're seeing on the horizon, if it does start raining over the next several months, then investors should be more prepared for that event. In other words, I would think about the investment outlook at the moment as, is there a chance that the Fed might begin to turn even more hawkish? They just turned slightly more hawkish last week, but if they do begin to send more hawkish signals, then we do see more upside risk to inflation. If we do see more upside risk in markets to the Fed adjusting their message, then that would have some negative implications for credit spreads, for equities, and they might also have negative implications for the dollar. So the short answer to your question, Lisa, turning this into investment advice and thinking about what the implications are, there are good reasons to be very cautious here in terms of the outlook, at least as long as this cloud is hanging out there and the fear of inflation still is so pronounced. In a few months' time, we will know if it did start to rain, if we did see inflation. But for now, there are still good reasons to be worried about the inflation outlook potentially being a bigger problem than what the Fed is appreciating at the moment.
Can you square for more then, Torsten, given that there's a labor problem, not a skills problem, why we have record 9.3 million job openings and no one wants to fill them?
Yeah, this is, of course, a very important discussion in terms of the labor market. There are more job openings than there are unemployed people. I mean, think about that. That tells you that by definition, we have a skills mismatch. The job openings are requiring skills that the labor market, the individuals who are unemployed in the labor market don't necessarily have. And that can not only be a skills match in terms of education and background, it can also be a mismatch in terms of geographical skills, that people live in the different zip code relative to where the jobs are. And a very important aspect of this is also that it could also be that the job openings have been in manufacturing, which is the goods sector, whereas a lot of the layoffs during the pandemic was in the service sector, again, airlines, hotels, restaurants. So we're seeing nice hiring and also nice job openings in the service sector, again, in the airline, hotels and restaurant and leisure and hospitality more generally. But we're also seeing very significant job openings in manufacturing. So it is this mismatch in the labor market, to your question, Taylor, that is very important, that we need to see a lot of the job openings be filled. And that's why you're seeing wages go up. I mean, think about in the full service restaurants have seen wages in the last 3-4 months go up by a full $1 from $15.50 an hour to $16.50 an hour. That's not coming down again. The best estimate here is probably that we will see wages stay at a more elevated level and, if you will, from a market perspective, see wages probably continue to go up. So that's why the labor market, that's not just a temporary issue. It is a very persistent risk to this inflation outlook.
Yeah, are we paying attention to the fact that once you raise wages, it's hard to cut them, so they're not necessarily transitory?
It is a ratchet effect. Once you have jacked wages up, then it is very difficult. You almost never see in any country around the world wages begin to go down. Even during recessions, it is very rare to see wages begin to move lower. So that's why also when you think about the year-over-year effect, it sticks, if you will, now that the 12-month window moves forward and the level of wages is now at this higher level and it's not going to go down. If anything, it might even go further up. So that's why the wage inflation issue is a very important issue when we think about what might be happening. And that doesn't mean necessarily that that will spill over to selling prices. It could also be that companies basically begin to see squeezed margins. But if that's the case, that's also another risk for credit and equities, because lower margin, think about the PE ratio. If the E in the PE ratio starts to go down, that begins to also bring some risk to the PE. And that's why valuations in equities and credit, as long as you have an inflation problem or an inflation risk, does look fairly vulnerable.
Hey, Torsten, it's good to hear from you, as always sharp. Thank you, sir. Torsten Slok, Apollo Global Management Chief Economist. I want to check in on the price action off the back of this, Lisa. Equity futures up by a little more than 0.1%, 42.62. Let's call it 42.63 on the S&P. Yields do come in about a basis point as this data comes in a bit softer. The yield right now, Lisa, 148.
And I think that this is actually the most important thing to note. No drama, not a massive reaction, but the fact that personal spending disappointed, that the real personal spending in particular actually dropped 0.4%, John. The idea here that we could be looking at services spending not offsetting the decline, the normalization in goods spending, really, I think, giving people a pause.
Peak everything. We'll continue this conversation around the open and bell as we drive forward towards the open. We'll catch up with Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College Cambridge president. We'll do that at around about 9:05 Eastern time, if you want to be super precise. And Lisa, continue this conversation. Have we now seen peak everything? Is that why we're seeing a lack of sensitivity, so to speak, diminished sensitivity at least, in this bond market?
I think he also wants to go to space with you.
Do you
think that, yeah.
I think Mohammed wants to come up to space.
He was, yeah, we were having a discussion earlier. He wrote in, he said, based on our salaries, we probably could afford a ticket. And
his or ours?
Yeah, ours. And then he was saying he's in academia. So, but I said, we'll do, that's what he said. So we'll be doing a remote and we'll be inviting you along as a guest.
That's Mohammed's excuse. He's in academia now.
That's his excuse.
Okay.
Good luck with that one.
I guess I can't argue with that. I'll whip through the price action, then I've got to run. Equity futures this morning up 7 on the S&P, advancing by 0.18% on the S&P 500. Coming into Friday at all-time highs, we advanced just a little bit. Let's call it 0.2% higher. In the bond market, yields are lower by a single basis point to 148.17. In the FX market, a euro now stronger, dollar weaker, 119.55 on euro dollar. And with that, WTI out to about 73.50, 73.46, up 0.2%. Alongside me, Lisa Brabitz. A special thanks to Taylor Riggs for waking up early in the morning the last couple of days. Tom Keane back on a Monday. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. At least 4 people are now confirmed dead in that collapse of a condo tower in the Miami area. Emergency crews are combing through the debris, and with more than 150 people still missing, officials in Surfside, Florida, fear the death toll will rise. There's no word yet on what caused the 12-story building to crumble. Court records show at least one resident had complained that the Homeowners Association failed to repair damages to cracked walls. And we're learning more about the Biden administration's plan to sell oil reserves to pay for the bipartisan infrastructure plan. Energy Secretary Jennifer Granholm spoke with Bloomberg Television this morning.
It's not selling off all of the strategic petroleum reserves. It'll be a limited sale to be able to meet the goal, which is the president's goal was he did not want any of these paid-fors, as you know, to raise taxes on those earning under $400,000. So this is one of several elements that were used as a paid-for, and again, it's a limited sale.
The bipartisan $579 billion infrastructural deal faces a complicated path in Congress. President Biden told reporters Thursday he expects Democrats to push through an even larger bill with more spending alongside the bipartisan legislation. But many conservative Republicans plan to fight both the bipartisan and the Democratic written legislation. And some liberals say they won't support one without the other. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keane, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Get this done. It's a very, very good moment. Good moment for America. Good moment, really, for the free world, and a good moment to push back against China.
That was Representative John Garamendi of California's 3rd District following the agreement on some sort of $579 billion bipartisan infrastructure bill. How likely this will get done, however, with the reconciliation tied to it, this idea that it will only get passed by Democrats, particularly the progressive wing, if there is an additional potentially $6 trillion bill attached to it. Terry Haynes joining us now. He has always been covering this and even assigning probabilities. This is one of my favorite aspects of Terry Haynes, is that he gives us hard numbers, even when they are hard to come by. Pangea Policy founder Terry, you parse through the noise and you say, though, that this is going to be a white knuckle ride for markets over the next couple of months as the reconciliation bill gets tied to this $579 billion infrastructure bill. What do you think the process is going to be like?
Well, Lisa, thank you. I think the process is going to be, like, first of all, let's not talk about it being a two-step process. It's a four-step process, but I don't want to overcomplicate this. Everything is pointing to four things.
Okay, traders, let's place our stop on profit even further, and I'm going to place move to 110.645. Okay, please do as well. Please place stop on profit even higher in our advantage, but because the short position we place lower, right? So that's it. Stay with me, and we will see. We're already £1,000 in profit, and then we will see. Maybe we will move again, because kind of movement gives really good opportunity to make really decent profit. Okay, guys, I'll speak to you later.
I'll give 30% to. We don't even know what it is yet, but not even all Democrats will support it. That's obvious from just the kinds of things Joe Manchin's been talking about, who started talking about there being too much debt right on cue from our conversation yesterday. So I think that's probably not going to happen. But it's going to take a while to sift out, frankly. And Biden doesn't have the ability to unite the warring factions of his party. Thus, a lot of the Washington confusion that sowed a lot of markets confusion yesterday.
Yeah, and there's a question about whether the $579 billion plan can get passed without anything concrete that's getting passed alongside it. Given the fact that you assign an 80% probability to that bill getting passed, do you think it's going to be a standalone?
I think it ends up being a standalone. Yeah, I mean there's going to be an awful lot of back and forth. Thus, why I call it a white knuckle ride for markets. There's going to be a lot of back and forth on process. Things are going to get linked up, or things not going to get linked up. There will be times where it looks like it, times where it doesn't look like it. I think what ends up happening is that the sort of the climate taxes families part kind of collapses of its own weight, because as we've talked before, I don't look at Washington as two political parties. I look at it as four factions. And what I know is all four factions have to agree on spending. All four factions have to agree on debt limit. All four factions want infrastructure, so therefore it's very likely. Who wants the other thing? The only people that want the other thing are one wing of one party. So that's very unlikely to happen. But they're going to have to be convinced by events that it's not going to get it done, and they're not able to convince the other three factions that they should get it done. So I think it's not going to happen.
The equity markets seem to be surprised or happy that there weren't tax increases in this proposal. Are you caught off guard by the fact that there are not tax increases, at least for the $579 billion?
No, I'm not, and the reason is very simply that the bipartisan group made part of their deal that there wouldn't be tax increases. So what you get is, in Washington speak, you get about $1 trillion tax bill roughly over 5 years. This is, and I say this roughly, this is about a 100% plus up in that period of time over what the federal government would have spent anyway. So, you know, it's a substantial amount of money, but at the same time, it's not as if we're throwing $6 or $7 trillion at infrastructure problems, and there's no guarantee that they're going to get done quickly. So, you know, the economic effect will be muted. You know, but they've put together for the 579 part, that's the new spending, they've put together what I thought was a pretty predictable grab bag of things that I think are pretty soft, but kind of get the job done in budgetary terms. But beyond that, you know, the tax increase threat will end up being in the families climate part of this thing, the reconciliation part. And you know, today I'll give you 30% that might happen, but I don't see them getting 50 Democrats on it, frankly.
Terry Haynes, Pangea Policy Founder, always so great to have you. Lisa, I think you said it right. I think we love getting Terry on because it kind of gives us the betting odds. We've migrated north from 75% odds to 80% odds of this passing. And this really has been in the zeitgeist of everything that we were discussing yesterday at the close. If you think about the equity market reaction, the tailwind of economic growth, no headwind yet of taxes. And then we go to your world of bonds, of course, which is seeing perhaps maybe not as much of a tailwind from global growth from maybe this policy.
Yeah, really the nut of what I've heard from the Congress members, from the policy wonks that we've heard over the past 24 hours, frankly, has been there doesn't seem to be a lot of market faith in that $5-6 trillion reconciliation bill getting passed or even really put alongside the $579 billion plan. And to me, that's the key, right? I mean, that's the idea that we just heard from Terry Haynes, that there's an 80% chance of this $579 billion infrastructure plan getting passed, but it will be standalone. It will not be attached to reconciliation. And perhaps that's the explanation for why you're not seeing more of a reaction in markets, that we're expecting something, frankly, bigger or around this size.
Yeah. What do you do after this? Do you get to go home and nap?
No, I've got other things. Are you kidding? I mean, are you going home to nap?
No, we are going to be on, Lisa, let's tease ahead, The Closing Bell. Romaine Bostick, Caroline Hyde, and Taylor Riggs will be doing that. We're going to see if we can continue to extend some of these record highs that we've continued to see, though. What's interesting to me is sort of the defensiveness, Lisa, that we continue to get with the NASDAQ and the NASDAQ 100. That, of course, as we know through 2020, has been the defensive sector that leads the way. And yet, of course, at least for the day, the Dow looks like it's making a comeback, one of the best performers. We love doing the Dow, Lisa, because it is price weighted instead of market cap weighted.
Yeah, John Farrow loves the Dow. He tries to quote that as much as possible, and Tom Keene always goes against that and tries to hide the Dow for some reason. Right now, we're looking at the NASDAQ up about 20, heading into the open, the S&P up just a little. I mean, no drama here. It's been basically up in the green just slightly all morning. The 10-year yield coming down a little bit more after the disappointing spending data, although still core PCE coming in at an annualized 3.4% rate, still well above the 2% yield that we're seeing, the 2% rate that the Federal Reserve is looking for. Meanwhile, coming up, we're going to be speaking with Libby Cantrell, PIMCO Head of Public Policy. That is at noon, New York time.
Let's go to
5 p.m.
space.
London.
Space.
This is Bloomberg.
I want to go to space, Lisa.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated. The world is possible.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City, for our audience worldwide, good morning, good morning. 30 minutes away from the opening bell with equity futures pushing higher and stocks at all-time highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. D.C. reaching a deal.
An awful lot of people talking about Mr. Biden's infrastructure spending.
The market just isn't convinced.
It's actually relatively small, much smaller than some of the initial figures we'd heard.
I think it was largely expected. This bipartisan bill is supposed to move in tandem with a reconciliation bill.
The bigger reconciliation deal both have to come.
Frankly, the U.S. simply doesn't have the capacity to implement that infrastructure spend.
Where will we find the workers to complete this infrastructure bill?
There is every chance that we see higher inflation.
I think at the moment, investors are far more focused on monetary policy.
Infrastructure spending can be notoriously slow.
July is going to be a busy month, though.
Is it really near-term stimulus?
It'll be a busy summer down in D.C., and the bond market, I think, will have to pay attention.
Let's head down to D.C. and catch up with our Washington correspondent, Bloomberg's Anne-Marie Jourdain. Good morning, Anne-Marie.
Good morning, John. And listening to some of those guests there, it is going to be a busy few weeks here in D.C. Punch Bowl this morning saying if you have a beach house, you better get insurance on it. So we had that $579 billion deal announced yesterday, bipartisan, but it's far from over. The President of the United States said he will not sign that legislation unless, as you hear, it goes in tandem with budget reconciliation. And Nancy Pelosi saying herself that if the Senate decides to pass the bipartisan legislation, again, she will not bring it up in her chamber. This is her red line, unless, again, it's alongside that budget reconciliation. So yesterday was all about hard infrastructure, pipes, bridges, safe water, some infrastructure regarding clean energy when it comes to being able to actually have infrastructure on the roads to fill up your green new car. But what the Democrats are looking for, and this is really a nod, John, to the progressives of the party, is human infrastructure, social spending, child care, a little bit more when it comes to climate change. And without that, the president will not sign this deal. So it's going to be a busy few weeks here in D.C., let alone how are they going to pay for this? A lot of gimmicks in terms of how they might pay for this. And also, not just the summer, John, but also the fall as well to get this done. Because by the end of the year, the whole city is going to be focused on the 2022 midterm elections.
I should have given my good friend a warmer welcome. Anne-Marie, around the world, from London to Russia, Japan, now in Washington. Welcome to the team down in D.C., Anne-Marie.
Thanks, John.
Good to see you.
Thanks,
Let's catch up soon.
Anne-Marie
Horton down in Washington, D.C., taking up her new position as our Washington correspondent. Let's head down to D.C. a little bit more and hear from the White House, painting the agreement as a victory. Writing in a statement the following: the president came into office promising to find common ground to get things done, and he's delivering on that promise. I want to catch up in Washington with Henrietta Trace of Vader Partners. Henrietta, your world, and I'm trying to understand, when they say we've made a deal, who's made a deal?
That's a great question. There are 11 people, including President Joe Biden, who have made a deal. So you need quite a few more before you can get to passage of any legislation. You either need 50 votes or 60 votes. There are 5 big pieces of legislation that need to pass in conjunction with the one plan that they rolled out yesterday. So as everyone has been saying, there is a tough road to hoe from here, and it's going to be a while. They need a lot more members to support this. I don't think you can count on any of the House Republicans endorsing any of the legislation from here. So you need every House Democrat, and you need every Senate Democrat, and at least 10 more Senate Republicans in order to get anything passed in a bipartisan way. It's going to be real hard.
Henrietta, I know these are moving targets. These are questions that are hard to answer, but what does the timeline look like through summer now?
I think what investors are about to focus and face is a peak headline risk moment yet again. So the process, as I see it from here, is that the first thing that's going to happen is Budget Committee Chairman Bernie Sanders is going to roll out a $6 trillion budget. That is going to call for $3.6 trillion in deficit hikes and $2.4 trillion in tax hikes. That's your peak. That'll come sometime in early and mid-July. Then you'll get a House version of that that'll probably ultimately get watered down to at least half. So our spending level will be $3 trillion. Our tax hike level will be 1.5, 1.2, and our deficit hike will be like 1.6, 1.8. They'll need to have that again, at least before it passes the Senate. So from July, mid-July through the end of July, you're probably going to see this peak headline moment of $6 trillion in spending and massive tax hikes. That will get watered down throughout the course of the rest of July, maybe into the first week of August. We'll see if they cancel the recess, and then we'll be having an earnest debate. My expectation with about 80% odds is we do this in late September, early October. They get back on September 20th, and we'll have this fight then.
Just to be clear, Henrietta, 80% odds we get what done? What specifically?
My expectation is that we get this bill passed in September. That my timing, September, October is my timing expectation with 80% odds, and also at 80% odds that we get an infrastructure bill. My odds that we get a partisan Democrat-only spending package are going to be tied to the debt ceiling increase. I think there has to be a debt ceiling increase, so that's 100% odds. As Elizabeth Warren has said, there will not be a scenario where we default on our debt. That's inconceivable. As a result, we will get a reconciliation bill. It will be tethered to the debt ceiling, and my expectation is that it'll be a pretty small package for Democrats. It will include a de minimis amount of any tax hikes, mostly deficit finance. It'll include a lot of energy tax extenders, fuel tax credits, et cetera, maybe an extension of the child care tax credit and the child tax credit, which are expiring. And most importantly, will increase the debt ceiling, which Congress is currently working on an October deadline for that.
Secretary Yellen came out with some really strong words regarding the debt ceiling earlier this week. Henrietta, I'm sure you saw them. Let's finish there. How messy is this going to get through the next month?
Well, I don't think this month is really when it's going to be terrible. I think they'll try to get it, moving with that fiscal 2022 budget I mentioned in July and early August. And then in October, late September, October, we'll have a real fight over the debt ceiling. They never increase that until they have to. The Treasury Secretary always calls for it to be increased before they actually do. And I suspect that members thinking October is the time horizon is what investors should focus on.
We have seen this movie before, several times. Henrietta, thank you. Henrietta Trace there, down in Washington, D.C., on an agreement one agreement, no idea if it passes or not. Mohammed Al-Arian weighing in on the bipartisan agreement, tweeting the following, quote, "The US infrastructure agreement is an important first step in a comprehensive policy effort to boost productivity and growth, certainly better than no deal, but the impact would be diminished without progress on, quote, the human infrastructure elements, thus the reconciliation package." Mohammed, I'll get into the policy details in just a moment with you. I want to start with the market if we can. 10-year yields 148, down a basis point. 30-year yields 2.1%. Let's round it up to 2.1% from 2.095 from where we are right now. Mohammed, this is a big shrug considering what's playing out down in Washington. Why?
Simply because of two things, John, and thank you for having me. One is, as we heard Anne-Marie and Henrietta, this is far from over, so the markets will wait to price it in. But secondly, and much more importantly, the market is now completely focused on this wonderful trifecta, the Goldilocks trifecta. Growth will remain strong, inflation will remain transitory, central banks will remain friendly. And as long as the markets are comforted with this, you're going to get not only well-behaved fixed income markets, but also, as I've kept on saying, the path of least resistance for risk assets is going to be higher for now. So that is what it is, really. Everything that the market is hearing and seeing tends to confirm the notion that this Goldilocks is going to last.
Let's repeat what you said. Growth strong, inflation transitory, central banks friendly. Is that your base case?
No. When I look at the inflation component of this, I think that inflation will end up being more persistent than the central banks anticipate, that central banks will change the definition of transitory. So suddenly transitory is going to be 9 months, 12 months. And then the big question is, will the marketplace go along? But when I look at what's happening on the ground, when I look at the changes, the structural changes to the supply and the demand side, I see a lot of elements in this inflationary process that are going to be persistent. Remember, there's a certain lag. We've seen this. It starts with commodity prices, then PPI, then CPI, then wage inflation. So saying now that you haven't seen wage inflation, it's too early, but I think you're going to see it.
Let's build on this. The Federal Reserve would say that the factors that are leading to a high rate of inflation now are going to fade over time, that the supply side of the economy will start to respond. What are the factors that you identify, Mohammed, that you think will lead to a more persistent, higher rate of inflation beyond this year and into next?
So to be clear, John, I'm arguing that you should have an open mind and stop this incredible conviction that it is going to be transitory. Why? Not because there are no base effects. In fact, we are in peak base effects. Not because there aren't any short-term mismatches between supply and demand. Yes, there are. But look at what else is going on. The labor market is not functioning the way you would expect it. You cannot dismiss all this on the basis of schools being closed or on the basis of the unemployment insurance benefit payments. There's more going on. There's about skill mismatches. There's about willingness to work. There are fundamental things going on. Look at what's happening to supply chains. Look at how companies are reacting. Look at what American Airlines did this week. It has a supply disruption. So what does it do? It reduces supply even more. If you put all that together, these things do not disappear in 3 months or 6 months. They have a long tail. And the only thing we don't know is how will households, workers, and markets react to the return on inflation. And today's PCE numbers are the highest since 1992. We have to put it in that context as well.
You and I are going to discuss the show me moment that could happen a little bit later this year. We'll do that in a moment. Mohammed Al-Arian with us through the next 30 minutes or so as we drive you through to the opening bell. Equities, all-time highs coming into Friday. Equity futures right now up 0.2%. At the market desk with your movers, here's Abby.
John, one stock helping the equity futures climb higher. Nike shares are popping on a very strong quarter. They beat both top and bottom line estimates in a big way, too. On the top line, they put up $12.3 billion, beating estimates by 12%. Adjusted earnings of 93 cents. That was an 86% beat. So lots of strength in North America. And then also importantly, the outlook, they're talking about $50 billion worth of sales in the year. Investors really liking it, those shares higher. Also true for the banks. The banks are higher after they passed the stress test very, very easily. This sets the big banks up to pass along payouts to investors. Shares are higher even with yields in liking those results. And then finally, of course, the infrastructure bill. It's very interesting here because we've had tremendous strength this week for a lot of these infrastructure stocks that suggested that traders thought that the bipartisan deal would pass. But the fact that you have this strength may also suggest that folks think that the reconciliation piece will pass as well and will pass along to the House. Not done yet, but the strength in these stocks suggests that that is the way the market is betting right now, John.
Interesting that that's what we see for the infrastructure names, but we don't see that really playing out in terms of the outlook for the bond market, with yields coming in a basis point, 148 on 10s, 2.1% on 30s. Coming up on the Fed, wrapping up a busy stretch of Fed speak this week. Officials sticking to the script, the core of the Fed going one way, the president's going the other. We'll talk about that in a moment. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's mostly temporary, so after inflation being at 3% or so this year, I expect both core and overall inflation rates to come back down.
But the risk is that instead of 3%, it turns into something bigger and more persistent.
Time for the liftoff of the Fed funds rate. That's still way off in the future right now.
There are, I believe, 7 members like me that are in the 2022 camp.
The very low Fed funds rate and also our asset purchases is supporting overall financial conditions.
The dots have been shifting forward, and we'll see as the data comes in.
We will see as the data comes in. Fed officials taking sides in the big inflation debate, this with fresh data supporting the Powell playbook, delivering a little bit of a downside surprise. Bloomberg's Carl Riccadonna joins us now for more. Carl, let's start here. What divides the FOMC right now between these two camps?
Well, I think the hawkish contingent of the FOMC is looking at a combination of both some frothy financial markets, or at least stretched valuations, and also evidence of rising inflation pressures at the moment. And really the difference is that conviction about whether we should be saying this time is different or whether it will be a transitory flare-up in price pressures.
I was talking to Mohammed about 5 minutes ago. We'll resume that conversation in just a moment about a potential show-me moment that could develop later on this year. And I'm picking out September. The reason I'm picking out September is because that's when the additional unemployment insurance expires. That's when the kids go back to school. We might see what happens with childcare through September too. Do you think that's when we could have this moment where we start to resolve the debate, that the evidence starts to shift one way or the other?
Well, John, Missouri is famously known as the show me state, so we'll call it the Missouri Minute, but I think it might take a little bit longer than September. September is going to be a crucial test period where we start to learn more about labor force participation and if we can really expect a full recovery from the huge decline that we saw during the course of the pandemic, which pushed participation down to Jimmy Carter era levels. We've recovered partially, but we've got a long road to go ahead of that. And so I think from September through the end of the year, then we will get a much clearer sense of what's happening. As we look at today's data on income and spending, of course, the inflation numbers aren't really telling us anything we didn't already know from the CPI. But when we look at what will be feeding the trend, income creation, it's decelerating. No surprise, given that transfer payments are fading into history here. But when we drill into the details and look at the wage and salary trend, we see a deceleration that's really been taking place since about October of last year. So the income trend is robust. It's not jeopardizing the cycle to any degree, but it's already telling us about the moderation in consumer spending, which we saw hints of in today's data and will continue through later this year. And that moderation in consumer spending is going to mean that the pricing power simply is not there. And to go to Mohammed's example about American Airlines, right, if they're cutting capacity, that may cause some temporary supply-related price pressures, but that's fewer pilots, attendants, and other workers getting a paycheck for providing a service. And so that further exacerbates this deceleration in the income trend.
Hey, Carl, good to catch up, sir. Thank you.
My
Carl
pleasure.
Riccadonna of Bloomberg Intelligence. I'll pick up on some of those themes individually. Let's start with who to listen to on the Federal Reserve. A little bit later today, we'll hear from Fed Presidents Kashkari, Mester, Rosengren, and Williams. Who do you listen to? Who do you listen to a little bit more? Take a listen to what former New York Fed President Bill Dudley had to say.
The thing to pay attention to is really the chairman, the vice chairman of the Board of Governors, and the vice chairman of the Federal Open Market Committee. So Powell, Clarida, and Williams. The big three set the agenda for the Federal Open Market Committee. The committee's not going to do something if those three people aren't on board. So it's about weight. Don't ignore the presidents, but don't put too much weight on what one individual president might say.
Let's turn back to Mohammed Al-Arian of Queen's College, Cambridge. Mohammed, let's start there. Who to follow over at the Federal Reserve right now? You've got the core, the trio of Williams, Clarida, Powell, all sticking a script, transitory, and then you start to hear from some of the Fed presidents leaning the other way. Where's your attention lie?
So I would completely agree with Bill Dudley. If you want to know what's going to happen to policy in the short term, you should listen to the trio. They are the ones that dominate, and they are going to take decision-making where they think it should be. Having said that, again, like Bill said, do not ignore the presidents. The presidents bring two things to the table. One is much closer to what's happening on the ground. They see what's happening in their districts. They have a good feel for what's happening in their districts. So don't ignore what they bring to the table. Secondly, at this moment in time, they are much more sensitive to the possibility that you end up not just with a policy mistake, but a market accident on the way to the policy mistake. So that's why they also stress the notion of financial stability. So I wouldn't ignore them. I think in particular, Kaplan, Bullard, and Bostic have interesting things to say that we should be listening to, but respect where the power lies, and that's within the core.
Carl Riccadonna brought up something you said about American Airlines, and he pushed back a little bit, Mohammed. He said it was temporary, that these issues won't persist. In fact, he's looking for that deceleration, that arguably we've already seen peak everything, and all this stuff starts to decelerate as this year grows older. What's your response to that?
So I thought Carl made a really good point. He said it's not just about whether the higher fares are temporary or not temporary. It's also about what it does to the labor market. So I heard his comments as saying, look, this has an implication for the labor market. And like him, I find it very upsetting that the participation rate, especially for women, especially for minorities, is remaining low. So he, I thought, brought an angle to John, don't ignore the implications for the labor market when he cited pilots and flight attendants. But we will see. Look, there is a notion out there that any price increase is just a one-off. And you had a really interesting discussion earlier on today. But it triggers other pricing. What do you think other companies are going to do when they see American Airlines raise fares? What do you think happens within a company when certain people get wage increases? Others start demanding relative comparability. So it may be one-off for here, but don't ignore the other dynamic. I'm not surprised that it tends to be ignored because we haven't seen that sort of behavior for a long time. So we have a big bias, behavioral bias, towards thinking that everything is one-off.
I'm lucky to have you for another segment. You and I are going to continue this conversation. Mohammed Al-Arian of Queen's College, Cambridge, on a situation in this economy and what it means for markets too. We'll touch more on the market side of the chat in just a moment. Coming up, the morning calls, and later, DC striking somewhat of an infrastructure deal, if you want to call it that. It's an agreement between some senators. Will it pass? It provides a boost for the industrials and construction companies. It does not provide a boost for Treasury yields. More on that ahead of the opening bell. From New York City this morning, looking down to DC with equity futures up 8 points, 42.64. We advance 0.2% for our audience worldwide. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
A little under 5 minutes away from the opening bell, going into the cash open this Friday morning. Good morning to you all. Equity futures right now up 0.2% on the S&P. We advance about 8 points, up 0.2 on the Russell, a similar amount on the Nasdaq too. That's the price action. Here are some of the morning calls. We begin with Credit Suisse upgrading Netflix to outperform, seeing a favourable entry point with a strengthening pipeline. Next up, JP Morgan downgrading Rite Aid to underweight, highlighting the company's earnings miss and weaker than expected guidance. That stock is negative 3.09% at 16.92. And your third and final call, it comes from UBS upgrading United Rentals to a buy, expecting Washington's infrastructure deal to serve as an upside catalyst. That stock is positive by 2.51% in early trading in the pre-market, 324.75. That's three of the calls. Coming up, Wall Street weighing in on the potential impact of DC's infrastructure deal. That conversation is up next with Mohammed Al-Arian and Goldman's Zach Pandor. Looking forward to that chat. From New York City this morning, good morning. Looking to wrap up the week and head to the weekend with equities sitting pretty at all-time highs. From New York at 42.64. This is Bloomberg.